including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes! We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright brothers airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was has Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest, because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world.
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the projects. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free?
HS Webmaster Tools, or AWT, is a completely free
it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source. and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash. Bloomberg
Bloomberg World Headquarters. I'm Charlie Pellet. The losses are continuing right to the numbers because the S&P is now down by 58 points, matching the low of the day right now, down 1.5%. The Dow down 450, lower by 1.4%. Nasdaq down 178, drop there of 1.6%. 10-year yield right now, 2.84%. We've got the 10-year up 20, 30 seconds. Spot gold now down $28 the ounce, down 1.6%. 18.23 on gold. Bitcoin up 0.5%, 28,550 on Bitcoin. West Texas Intermediate crude 105.50 a barrel, down 27 cents now, a drop of just about 0.3%. Key takeaway here, brutal volatility continues to grip financial markets, roiled by the threat that restrictive central banks will sink the global economy into a recession. Tech shares are continuing their losses. Again, the Nasdaq 100 index now down by 1.8%. The Walt Disney Company, its shares lower after reporting subscriber gains for its flagship streaming service that exceeded analyst estimates but tempered its outlook for the balance of the fiscal year and said it will trim spending on movies and TV shows. Geetha Raghunathan is a media analyst with Bloomberg Intelligence.
Previously, it was all about making this pivot to streaming, to direct-to-consumer. If you were not making that pivot, you were punished. Now, if you've made the pivot, you're getting punished as well. So it's really this very, very funny time. And of course, again, with the parks, there is this economic overhang. Again, investors worried whether they're going to be able to replicate the strong performance, quarter in and quarter out.
And Disney shares, they are lower now by 2.4%. Also after earnings, Bumble surging 22.75%. Rivian Automotive up 16%. And also after earnings, Beyond Meat shares, it is down now by just about 1%. Recapping stocks lower, I'm Charlie Pellet. That's a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, folks, it is Friday's Eve, and it couldn't come sooner. It is Thursday, actually, May 12th, 2022. It is Friday's Eve. We are down again with lots of swings again. Apple officially in bear market territory, a little perspective there. We're going to talk about markets and another U.S. inflation print in just a second.
Yeah, we got a blockbuster lineup of CEOs this afternoon, Carol. We got two stocks storing on quarterly updates that we're going to talk to both of those CEOs, including Joanne Crevasera, the CEO of Tapestry, that's the owner of Coach, Kate Spade, and more.
That stock is outperforming, rallying big time. So too are shares of Sonos. We're going to catch up with the CEO, Patrick Spence. And then our CEO parade continues as the chairman and CEO of Carrier Global joins us in studio. So can't wait to pick their brains about inflation, market volatility, and outlook.
Plus, this guy's been a CEO in the past. He's credited with creating the iPod and building the iPhone. He founded the smart home company Nest. Tony Fidel's going to be joining us. He's got a new book out.
All right, we're going to get to all of that. First up, though, let's get to the markets and the market drivers report. Let's set your Business Week agenda on this Friday's Eve. Kriti Gupta, markets correspondent at Bloomberg, here in our Interactive Brokers studio, along with Michael McKee, international economics and policy correspondent at Bloomberg News. Here's where I want to see if Mike and Kriti align in terms of the selling that we continue to see on the markets based on the economic fundamentals. So, Kriti, first of all, set the stage in terms of what we're seeing in the trade, because it's more selling.
You're just putting me up on a pedestal so Mike McKee can knock me down. I'm just kidding. He would never do that. Hopefully,
it's a new carnival game.
We'll find out. Listen, I don't think this isn't panic selling. It's not. And you see that across the board. A lot of the folks I've spoken to who are actively trading this saying this is a market that is still functioning. This is a market that doesn't require any assistance, any extra liquidity.
To be clear, you're talking about the equity market, not the cryptocurrency
Yes, we're not
market.
talking about.
Okay.
Can we just separate
Yeah,
the
we're
two?
separating.
Can I actually say we're talking about the real market? Oh, disc. Go ahead.
Wow, Carol.
They're all send the hate mail. Send the hate.
Send the tweets to Carol Masser.
Circle that back on that. But listen, this isn't panic selling. This is a reset. And there's really no other way to put it. And I'm going to actually steal what Mike McKee just said 2 minutes ago, is that if you were to look at a long-term chart, and if you were to look at how big the rally has gone and then put this sell-off in perspective, it isn't actually that big.
Especially in tech, right?
Specifically in tech, because it has gone so much bigger. That being said, that doesn't mean mean you don't have anything to worry about. I think the bigger story in markets right now, it's not in the stock market or the bond market. I think it's in the currency market. It's in the dollar story. And it's this continued dollar strength that is rippling across everything to the point where the negative or the inverse correlation with the S&P 500 is one of the strongest in a decade. And I think also if you look at what's going on in the cryptocurrency market, no one's really connecting these. But if you look at Tether or if you look at Terra, these are stable coins pegged to the dollar. And so if you continue to see dollar strength, a lot of the ripple effects, I'm not saying that's what's happened, are going to show up in some of these stable coins. So in a way, it is all connected.
Okay, she's up on her pedestal. What do you got for us, Mike?
Bring it on, Mike.
So fundamentally...
I will leave her on her pedestal because as far as I am concerned, that's right. It's... I was asked for advice this morning by someone, and I said, well, you don't spit into the wind, you never shake hands with a left-handed gunfighter, and stocks go up and stocks go down. And
is that a thing?
Deep thoughts with Mike McKee.
And so, you know, stocks go, as long as the markets are functioning, that's what they do. I mean, people, they go up and they go down. I mean, people talk about the Fed acting until something breaks, raising rates until something breaks. Well, you know, you've been doing this long enough that the market goes up until something breaks, and then it goes down again, and then it starts going up again. So if there were something fundamentally wrong with the economy or the market world like there was with the great financial crisis, then you'd have a different case to make. But right now, it's a classic case of demand exceeding supply for various reasons. The Fed's going to have to act. Maybe not, we get a recession, but then stocks just reset and go back up again, as long as they're functioning, as long as you don't have everything in one stock.
You're too calm, Mike.
But there's liquidity in the markets. It's not like all of a sudden we're seeing a crunch or a seize, especially in credit markets, like watching those financial market conditions.
Well, this is something that we could have predicted in the sense that we've had the so-called Fed put for almost 20 years now. And now the markets are going to have to get used to functioning without that extra liquidity. And they managed to do it for 180 years before we got to the great financial crisis, so they can probably figure it out. It just will be a little bumpy.
Peter Atwater of William & Mary, who shares notes with us, and he's out on Twitter, and he says, it's not a tech sell-off, it is a massive repricing of abstraction. We had a bubble in dreams. We're going to talk a little bit about that.
Well, and that's why you say, I mean, if you look at, you know,
nice way to put it.
What, you know, certainly Apple's in bear market territory, but, you know, you have the S&P 500 down this year, 18.6%. The NASDAQ's a different story. But it's a different story if you take a look at, you know, some of the individual names that have seen serious drawdowns. I mean, we're talking over 70% for Netflix from its highs. Tesla's lost a third of its value in just a few months, Creedy. So what would you say to someone who pushes back and said that we are seeing some panic selling when it comes to those more high-flying names?
I would say look at what those high-flying names are actually doing. Netflix has a real reason to worry when you're looking at the fundamentals. Zoom, for example, has a real reason to worry when you're looking at some of these changes in the way you work. If you compare this to, say, an Apple, which is still thriving, which is still doing very well in terms of just how much cash cushions it has, which was really the reason the stock was driving so high in the first place, that is a different story because that doesn't seem like it's driven by fundamentals.
But help me out. Netflix has a market cap of about $75 billion, and it's expected to show revenues of $32 billion this year. I mean...
Yeah, well, some of these are trading at extreme valuations. There's no question about it, and I think it brings you back to actually chart my day a few days ago. Is that what is the stock market actively responding to? Is it operating margins, which it was for a while, right? The inflation passing on, or is it valuations? And it's now turning back to valuations, and we haven't talked about PE ratios or sales to a book ratio or whatever for the last 2.5 years.
Oh, it's kind of funny with PPI today. There's a category called trade services, which is basically margins for wholesalers and retailers, and it was negative on the month for the first time since 2020.
So they're getting squeezed and not passing it along?
So they're getting squeezed, and that could be just a one-off, but it could also be the start of a turnaround in that, okay, we can't keep passing along the price increases. Our margins are shrinking a little bit, so maybe we've got to impose some other discipline. It's something to watch going forward, and it is just one little indicator, but those things can happen.
When's the next Fed meeting?
The next Fed meeting is June 15th.
Okay, counting down to that. All right, Michael McKee, of course, international economics and policy correspondent at Bloomberg, and Creedy Gupta, markets correspondent at Bloomberg. You are set up for Friday's Eve.
Let's get to world and national news. Nancy Lyons standing by in D.C. Hey, Nance.
Thanks, Tim. The House committee investigating the January 6th assault on the U.S. Capitol has taken the extraordinary step of issuing subpoenas to House GOP leader Kevin McCarthy and 4 other Republican lawmakers. The subpoenas are certain to lead to extended court clashes, potentially rooted in the Constitution's speech or debate clause that shields lawmakers. President Biden is marking a tragic milestone: 1 million American lives lost to COVID. He addressed the grim statistic in virtual remarks to the global COVID summit.
It's grief shared by people across all of our nations. Around the world, many more millions have died. Millions of children have been orphaned, and with thousands still dying every day.
Biden has ordered flags to be flown at half staff in the U.S. Protection is apparently one key reason Finland's leaders have decided to move quickly and apply for NATO membership. As Bloomberg's Amy Morris reports, it paves the way for a historic expansion that could deal a serious blow to Russia.
The move means Finland is all but certain to join NATO. NATO Chief Jens Stoltenberg says the ascension process would be, quote, smooth and swift once Finland formally decides to join. The Kremlin reacted to the news hours later, saying that Finland joining NATO will not help stability in Europe. The Kremlin had warned of military and political repercussions if Finland and Sweden decided to join NATO. Sweden is also expected to decide whether to join in coming days. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. We talk about wacky days. Check it out. Just shares of Twitter, down 6% at their lows, up 3% at their highs. That is the market in a nutshell. Right now, the stock's still down about 2.6%. A couple of stories that crossed, one in particular that caught our attention by Kurt Wagner and Sarah Fryer. Twitter CEO coming out and announcing a hiring freeze and other cost-cutting efforts today, a reflection of the company's state of uncertainty while it waits Elon Musk's $44 billion takeover.
Yeah, Twitter's not going to hire new employees. They also may rescind some offers that are already out. That's according to an internal memo that was obtained by Bloomberg. Some exceptions.
That's serious,
That's
right?
very
when
serious.
You're like, we're taking them back.
Some exceptions will be made for business-critical roles as determined by Twitter leadership. The company is also pulling back on costs such as travel, consulting, and marketing, according to the memo. Okay, here's the thing, Carol.
Right.
This is happening across the industry right now. This is not a Twitter-specific story. So you do
All
have
tech, you're saying?
Not all tech, but you are seeing a hiring freeze in other companies. You're seeing some companies pull back on spending. I mean, look what's happening at Meta, for example, the parent company of Facebook.
Amazon.
And you're also seeing it, you're seeing a lot of venture capitalists start to talk about this on Twitter because of the market drawdowns that we've seen, that there is going to be a likely pullback in spend when it comes to venture capital, too.
You know, I'm curious what the carrier CEO has to say with us because they're innovating. They've got to think about technology, certainly, as they advance their product line. So I'm curious what he has to say. And I think about coming off of Milken, all the CEOs I talked to, like the ones in retail, it was the CEO of Lowe's, CEO of Kroger, and others. You know, the one theme that was consistent across all of them was the importance of technology and the need to spend. So, but again, at the same time, they were cautious. So you do wonder, yep, we know it's important, but we may not be able to spend potentially. And maybe that's what we're starting to think about.
Look at Uber, for example. I mean, look, it's not profitable on a GAAP basis, but the company CEO, Dara Khosrowshahi, coming out with that memo over the weekend that says we got to change the way we're thinking. We are going for, actual profitability and cash flow positive.
All right, Twitter, Elon Musk, we do want to mention Elon Musk aiming to scrap the margin loan with new Twitter founding. He's in talks to raise enough equity and preferred financing for his proposed buyout of Twitter to eliminate the need for any margin loan linked to his Tesla shares, according to those in the know. It's good to be Elon. See, we're just living in Elon's world. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Lows of the day right to the numbers. S&P down 62 right now, a drop of 1.6%. The Dow down another 514 points. Right now, lower by 1.6%. NASDAQ down 194, down 1.7%. The NASDAQ 100 index down now by 1.95%. 10-year yield, 2.84%. Brutal volatility continues to grip financial markets. Prices paid to producers rose more than forecast in April. The data suggesting Fed officials will keep tightening monetary policy. Again, that 10-year, 2.84%. Spot gold down $29 the ounce. Right now, gold is at $18.22 the ounce, down 1.6%. Bitcoin up 0.2, 28,478. West Texas Intermediate crude up 0.3%, 106.01 a barrel. Lots of names reporting after the close of trading today, including Joby Aviation up now by 5.6%, Toast Inc. up by 9.1%, Figs, the uniform company, up by 0.5%, the Doctors Uniform Company, and Houlihan Lokey also reporting after the bell, down by 0.3%. Recapping, S&P down 59 now, drop there of 1.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, certainly tough in the overall market, trades and broad-based selling, but not selling. Investors snapping up, in fact, shares of Tapestry. Stock has been as high as 19% in today's session, still holding on to about a 14% gain. And this despite the parent of Coach and Kate Spade cutting its profit outlook due to pandemic closures in China. Meantime, a bright spot, North American demand lifting third quarter sales above estimate. So let's get to the quarter and find out what the consumer is up to. Delighted to be talking once again with Joanne Crevoiserat. She is CEO of Tapestry, and she is on the phone in New York City. Joanne, so nice to have you here with Tim and myself. How are you, and how is the retail environment doing?
Yeah, well, thank you, Carol and Tim. It's great to be here. Thanks for having me. What we're seeing in our business is strength and momentum across our business. As you mentioned, our third quarter outperformed, led by strength in North America, and we drove double-digit global sales growth across all of our brands at Coach, at Kate Spade, and at Stuart Weitzman. And, you know, Tapestry is a powerful combination of iconic brands that offer tremendous value for consumers, and we have a platform that we've transformed to drive innovation and customer engagement. And that model is delivering results. We're seeing that in the strength of our digital business, increased customer acquisition, and pricing power across brands. So a lot of things are working and performing, and it really reflects the strategies that we've put in place over the last few years to stay closer to our consumers and drive growth behind our powerful brands.
Joanne, we want to dig deeper into that, but let me ask you, if you had to describe the consumer in a word or a few words, how would you do it? And would you say that the consumer is back at pre-pandemic levels, or maybe even better, or still a little bit under it?
Yeah, the consumer is quite resilient. You know, we've been driving growth above pre-pandemic levels for several quarters. And, you know, that's most apparent at our Coach brand, where we've had more quarters in a row, but also true at Kate Spade and at Stuart Weitzman. And, you know, our business in the third quarter reflects really the strength and momentum we're seeing around the world. You know, we talked about our growth in North America. We drove 22% growth in North America in the last quarter. But we also saw strength around the world in all areas except for China. So we saw strength in Europe and strong growth in rest of Asia as well as in Japan. So business is performing. In fact, even in China going into the quarter, we saw strength, and you know, that business only started to weaken when we saw the disruption related to COVID in the market towards the end of the quarter. So we're seeing a consumer that is engaging with our brands. They're getting out into the real world. There are real life occasions. And, you know, we see them engaging with our brands and our categories in handbags and footwear. And in fact, we just came off a great Mother's Day. So that continues, and the consumer really continues to engage both, again, with our brands and in our categories.
Joanne, I want to hit on the China point and dig into that a little bit, because you had to have, in North America, you overcame pandemic-related weakness in China when you look at the results overall. But I'm wondering from a planning perspective how you're thinking about how long these lockdowns last and how long you're going to see that weakness in China where business has just dried up since this resurgence of COVID.
Yeah, the business was disrupted, but it was disrupted in a very discrete way, by the impact of COVID in the market. And, our business has been quite resilient over the last 2 years. As I said, we've been driving growth above pre-pandemic levels for some time. And that shows the resilience of our model and the way that we're able to shift to changes that we're seeing in demand and changes in the supply chain and supply around the world. And our latest disruption has been in China. But as I mentioned, we had strength in the market, and we've been driving strength. As China came out of the first round of lockdowns, the consumer was incredibly resilient. And we were driving growth significantly above pre-pandemic levels for a number of quarters. Again, as you pointed out, they've been hit by another round of COVID lockdowns, and that has impacted traffic in the lockdown cities, but also more broadly. It's also impacted some of the distribution centers and logistics in the market. And so we're feeling the impacts of that. Our expectation is that we expect Shanghai to begin to reopen at the beginning of June, and we expect a gradual recovery, probably more gradual than what we saw last time we came out of lockdown, but we do expect a gradual recovery. And, our brands are targeting the middle-class consumer in that market, which is an attractive market and growing market. And we feel well-positioned as that market recovers over the near term, but as well for long-term growth, with longer runway ahead.
Joanne, there's so much stress out there, it feels like, certainly when we watch the financial markets, right? And we look at some individual names, even though your stock's rallying, it's down about 25% this year, but it's broad-based selling. It feels like no market or sector is immune, it certainly seems, in the stock sell-off. You sound pretty calm, and you sound, I don't know, is it cautiously optimistic? Help me understand fundamentally what the outlook looks like that might, I think we're all trying to figure out what is the outlook amid a rising rate environment, and what is the business environment, and what's the market environment? Because you seem pretty calm.
Yeah, well, and we are optimistic. We're very confident. We have such iconic brands in our portfolio, and our focus has been on restoring the health of our brands and driving better and stronger engagement with consumers. And when we do that, the business performs. So we're really focused on fundamentals. And when we talk about transformation, actually, I heard you discussing investment in the business in the show just prior to when I came on. We're investing in digital tools and innovation and technology that's making us better. And as we focus on the fundamentals, we're seeing traction. We're engaging customers. We're acquiring more customers. We acquired 1.4 million customers in the last quarter alone. And since we've embarked on our transformation, we've acquired 13 million new customers to our brands over the last 21 months. And these are customers who are coming in and engaging with our brands. They're shopping at higher AUR, higher prices than average, and they're coming back more frequently. And these customers are also increasingly younger. So as we focus on the fundamentals of our business, it gives us confidence because we're seeing much stronger engagement, much healthier brands, and much stronger engagement with our consumers.
Joanne, I'm wondering about your pricing power, because you said that these customers are paying more than they were paying earlier. How much of that has to do with inflation? Where are you seeing a rise in costs right now on your production end and in your supply chain? And how much are you absorbing of that versus passing it along to the customer? Because as Neil Saunders, an analyst with Global Data, said in a note after your results, the customers that you have at Tapestry can cope better with inflationary impacts than the average customer.
Yeah, and the way we think about our pricing power is really in terms of delivering value to consumers. And that's how we've been thinking about it. In fact, we started this pre-pandemic, before we started to see pressure on the cost side of the equation. And those pressures are real. We're seeing pressure on the cost side of the equation like others in the industry. A lot of pressure in freight related to the supply chain dislocations that we're seeing. But our focus really on the pricing side of it and the pricing power is really driven by the value we're delivering to consumers and those emotional connections that we're developing are allowing us to drive pricing power. And we're seeing that across our brands. You know, some of the investments we've made in tools and technology are helping us leverage data better across our value chain. So that's making us more informed on pricing decisions. It's also making us more informed on our assortment decisions and our inventory management. So we've got the right inventory. We're seeing higher SKU productivity with more concentration behind more powerful items, and that allows us to drive pricing power as well and to clarify our messages with consumers. So on the value side of the equation, we continue to deliver unbeatable value for our consumers across all of our brands, and that's helping us more than offset the pricing pressure that we're seeing in terms of cost, in terms of our expectations going forward.
You know, Joanne, when you were part of a Bloomberg panel that we did, you and I did it with a few other heads of companies about a year ago, and we talked about disruption as the new economic driver. I think part of the conversation we also got into what consumers want in terms of sustainability, and ESG is such a big part of everywhere. Tim and I are back from Milken, and we talked about it with every conversation. I am curious about how you guys apply it at the company, and I'm really intrigued about this craftsperson apprenticeship program because I think it's a way of creating jobs and also, you know, creating really strong sustainability initiatives at the company.
Exactly. Yeah, we're really thrilled to bring that to bear, that craftsman apprenticeship program. And the way we think about ESG has been part of the fabric of our company from the beginning. And we value and we think about it in terms of what we're bringing and delivering for our people, for our planet, and for our communities. And part of that effort, and some of those efforts include sustainable materials and the circular economy. And Coach is a great example of where we're leaning into the circular economy with our Reloved program that takes product that can no longer be repaired, and we relove it literally, and when we restore it and we bring it back to health. Our designers are working on it. Our repair centers are working on this product and restoring it and bringing it back. And we've seen unbelievable reaction from consumers. This is something consumers are asking for. It's something our associates love to do.
Yeah.
And as we think about scaling these programs, we are looking for more people to get involved in terms of leather craftsmanship. And that's part of the apprentice program that we're developing to allow us to further scale these programs.
Gotta say, I'm an older consumer, but my daughter is 19 and she's a younger consumer. Those are the kind of things that really make us take a second look at a brand. So I think you guys are onto something. Joanne, so great to check in with you again and get an update on retail and really your company specifically. Joanne Crevoiserat, she is CEO of Tapestry, on the phone in New York City.
Thanks so much, Joanne. In the meantime, let's get a check of the latest world and national news. Actually, let's get a check of the markets. Here's Charlie Pellet.
Hi, thank you very much, Nathan Hager. Here's what's going on. It is a down day on Wall Street, but look at Tapestry shares, by the way, up now by 14.1% on Tapestry. We've got the Dow, the S&P, NASDAQ very much on the minus side as brutal volatility continues to grip financial markets, roiled by the threat that restrictive policy by major central banks will throw the global economy into a recession. Right now, the Dow is down 500 points, down 1.6%. S&P 500 index down 60, a drop there of 1.5%. NASDAQ down 178, a decline of 1.6%. NASDAQ again lower the year, down by 28.5% so far for 2022. The 10-year right now, the yield 2.83%. Spot gold down $30 the ounce now, down 1.6%, 1822. Bitcoin is advancing by 0.1%, 28,436 on Bitcoin, and crude up 0.7%, 106.30 a barrel. Summer air travel costs are on the rise. Yesterday, we got data showing airfares had their biggest one-month spike on record. The increase of 18.6% from a month earlier was the most since the Bureau of Labor Statistics started tracking the category in 1963. Helene Becker is an airline analyst at Cowen & Company, and she told us this morning, when it comes to higher airfares, we are not done yet.
We're thinking they'll go up something like 7% a month through at least June, maybe into July. But costs are going up. Labor costs have gone up quite a lot. We've talked about higher fuel costs. Airport expenses have gone up.
Fares up, airline stocks down today. UAL tumbling 6%, American Airlines Group down by 5%, Delta down 4.9%, Southwest down 3.3%, JetBlue lower now by 2.3%. Again, recapping, stocks lower, just about the lows of the day, with the S&P now down 67, down 1.7%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, appreciate the update, Charlie. So selling on Wall Street, we're also continuing to see hemorrhaging when it comes to the crypto market. Cryptocurrencies dropping more as the collapse of the Terra stablecoin triggering a flight from many popular digital tokens. And we did have U.S. Treasury Secretary Janet Yellen addressing the meltdown to lawmakers up on Capitol Hill, specifically to the House Financial Services Committee earlier today.
I wouldn't characterize it at this scale as a real threat to financial stability, but they're growing very rapidly, and they present the same kind of risks that we have known for centuries in connection with bank runs.
All right, that, of course, was U.S. Treasury Secretary Janet Yellen, of course, former Fed Secretary, Fed head, I should say. I just want to point out, sorry, I'm doing double duty. Fed Chair Jay Powell winning Senate confirmation to a second term, and that headline just crossed the Bloomberg terminal, so just wanted to mention that as well.
That's been
you actually flagged it.
That's been a long time coming.
Yeah, a long time coming. All right, so Janet Yellen talking about crypto, so let's get back to it. We've got a great person to talk to.
Olga Karif is crypto reporter for Bloomberg News. She joins us on the phone once again from Portland, Oregon. Olga, good to have you back with us. I want to start with really what we're seeing in terms of the decline of algorithmic stablecoins and even non-algorithmic stablecoins, just a traditional stablecoin. Give us an update on what we're seeing right now and the way that has spread in the last 48 hours to other parts of the crypto industry.
Sure, I am glad to be here. So what happened was a stablecoin called Terra USD essentially collapsed this week. And the ripple effects of that spread throughout the crypto ecosystem. For instance, Bitcoin is down, 20% for the last week, and pretty much most coins are down in the double digits. And the reason for that is that stablecoins are a key to the cryptocurrency ecosystem. Traders basically step into stablecoins at times of volatility, and when stablecoins are unstable, the whole the foundation of the entire cryptocurrency ecosystem becomes shaky.
Well, I do wonder, we've talked with you, yesterday, and just wondering how people, need to be looking at this. And I think we talked about, how this was similar potentially, and I know we have with other members of our team about maybe similar to how this was the dot-com era, where, a lot of the dot-com era stuck, right? But a lot fell to the wayside. We're trying to kind of figure our way through this.
So I think that's a great analogy, and it's this sort of huge price decline is not new to crypto either. We've had a crypto winter in 2018, for example, when literally thousands of coins and projects died. And I think, if we have an extended crypto winter now, we will see the same thing where, some of the weaker projects die and some of the stronger ones emerge stronger. And maybe we'll see a lot of innovation and some new ideas come out.
But is this a little different, though? And I want to push you on this a little bit, Olga, because even if people haven't been following and living through the crypto winters of 2017 and prior to that, there seems to be something more systemic going on here. And I'm wondering if you agree with that.
What's changed since that time is that we've seen a lot more institutional adoption. So we have, during 2018, we had a lot of people holding this because they believe in the spirit of crypto. They love the idea of decentralization. They love the idea of money independent of government control. Whereas today, a lot of crypto is being held by institutions that are kind of more thinking profits versus the philosophy of the whole thing. So that's why we are seeing crypto move sort of in parallel with other risk assets in this case, because I think the user base has changed.
How so? Because there has been more institutional adoption. I do wonder, Olga, though, when it comes to companies that have, look, we saw record venture capital pouring into crypto companies last year. More venture capital went into crypto last year than in all previous years combined. And we even saw a record in the first quarter of this year. I'm wondering, though, with the news from Coinbase that we got earlier this week and trading volumes being down, if we start to see a serious pullback at a moment when we're just starting to see traditional finance become more involved in DeFi.
Absolutely. I think the pullback has started, and it's pretty much everything is going to ground to halt now, because if you recall earlier this year, we've seen very high valuations for funding rounds for blockchain.com, for Gemini. And today we see that Coinbase's market cap is lower than some of the, like blockchain.com's valuation, and Coinbase is a much, much larger company. So that makes you wonder about valuations of crypto companies. And VCs I talked to today basically say that everybody's taking another look at valuations, and that there's not going to be as much money available for crypto companies in the near term.
All right, we're going to leave it on that note. We really appreciate the update. Certainly an ongoing story we continue to follow. Olga Karif, she's crypto reporter at Bloomberg News, on the phone in Portland, Oregon.
I want to go back to some of those headlines that you mentioned at the top of our interview. Fed Chair Jay Powell winning a Senate confirmation for a second term as Fed Chair. The Senate voting overwhelmingly bipartisan, 80-19. It does come as the Fed grapples with soaring prices amid criticism that it was essentially behind the curve, slow to act against a threat that's angered Americans and hammered President Joe Biden's popularity.
Yeah, Powell 69 is Biden's fourth Fed nominee to win confirmation. Economist Philip Jefferson confirmed with bipartisan support. That was yesterday. Lisa Cook, who was opposed by Republicans, won confirmation by the narrowest margin on Tuesday, with VP Kamala Harris providing the tie-breaking vote. And Lael Brainerd, as you recall, was confirmed as Fed Vice Chair last month. But again, Jay Powell getting the support, believing that he can tackle the highest inflation to confront the country in decades. And of course, we did get another print on that, the producer price index that was earlier this morning.
Let's get to Washington, D.C. now for a check of the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. The U.S. has been hosting its second global summit on COVID-19, all virtual, with President Biden acknowledging the U.S. has reached a grim milestone, 1 million deaths.
1 million empty chairs around the family dinner table. Each irreplaceable losses. Each leaving behind a family, a community, forever changed because of this pandemic.
Biden told other leaders the fight against the virus is not yet over, and says we all need to double down on getting shots in people's arms. He has ordered all U.S. flags to fly at half-staff. Jerome Powell has been confirmed this afternoon by the Senate for a second four-year term as Fed chair. He will be challenged by inflation at historic highs. Well, Democrats are making a new push to force companies to explain why they're charging more.
Senator Elizabeth Warren has drafted a bill that would require companies to disclose their reasons for raising their prices and would provide $1 billion to the Federal Trade Commission to investigate price gouging. In a statement, Warren says consumers are paying more while giant corporations are using inflation as a cover to expand their profits. The bill would exempt small businesses that earn less than $100 million from some of the reporting requirements. It would also clarify that price gouging anywhere in the supply chain is illegal. In Washington, I'm Nathan Hager, Bloomberg Radio.
5 Republicans are being subpoenaed by the House committee investigating last year's Capitol riot. The list includes Minority Leader Kevin McCarthy, Ohio's Jim Jordan, Arizona's Andy Biggs, Pennsylvania's Scott Perry, and Mo Brooks of Alabama. All 5 refused invitations to testify voluntarily. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. Sticking with cryptocurrencies, specifically the Terra USD stablecoin. This is our most read story in the past hour. It has to do with Terraform Labs.
Yeah, Terraform Labs restarting the Terra blockchain following a software update to help avoid attacks against the network in the wake of the collapse of its algorithmic stablecoin and the related Luna token that had roiled cryptocurrency markets. The company is sending out a tweet that says the Terra blockchain has resumed block production. The delegations are disabled now that the chain is live with the new code merge. Validators, please check the Discord announcements for the latest patch notes. Carol, this fix is designed to help avoid so-called governance attacks against its protocol. That's a way of manipulating the fundamentals of a given blockchain by requiring enough tokens to force a majority vote.
All right, so keep in mind, you've been learning about this. If you weren't familiar, Terra's UST is one of the world's largest stable coins, while its corresponding Luna reached an all-time high of $119 only last month, which just speaks to the volatility and also the downfall that we've seen. Its fall has been quick and fast, leaving the wider crypto community at a loss for how this might impact the broader ecosystem, and this is what's happening. You now look at everything, right, all within the crypto universe. We're seeing it under pressure, and ultimately there will be some dropout, some fallout, and then we'll see what happens on the other side of this.
Well, here's what
happened. Where investors come back in.
Exactly, and here's what's so notable about what happened before it was brought back. That halt meant that no transactions occurred on Terra's blockchain while the system was shut down. So what that did was it forced the price of the two tokens to stop moving. So the value of UST, which it's the algorithmic stablecoin, it uses that complex mix of code and trader incentives to keep its peg to the dollar. That was at around 36 cents, Carol, before the blackout. Luna, that sister token to UST, it helps maintain the former's price, had fallen close to zero on Thursday. That was at $119 last month.
We talk about superlatives, like in other parts of the kind of historical normal plain vanilla financial markets, but you see those swings. That's tremendous, like just wiping it out.
Unreal.
All right, folks, we are following this and, of course, the overall market trade. We're going to talk more markets in just a moment and what's going on with the selling and what's been priced in. This is Bloomberg.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. No let up in the selling. The S&P now down 71 points. Lows of the day down 1.8%. We've got the Dow down 570, a drop there of 1.8%. NASDAQ down 215, down 1.9%. The 10-year yield, 2.82%. The NASDAQ 100 index, by the way, down 2.1%. We've got gold down $29 the ounce, down 1.6%, $18.22, while crude, West Texas Intermediate, up 0.7%, 106.41 a barrel. Brutal volatility continues to grip financial markets. Prices paid to producers rose more than forecast in April. That data suggests Fed officials will keep tightening monetary policy. Twitter shares trading lower by about 4%. Twitter has announced a hiring freeze and other cost-cutting efforts, a reflection of the company's state of uncertainty as it awaits Elon Musk's $44 billion takeover. Twitter shares lower, and so are Tesla shares. Right now, Tesla is down by 2.7%. Recapping 10-year yield 2.82%. S&P down 68, down 1.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, appreciate that update, Charlie. And we are really just hovering, as Charlie mentioned, near our lows of the day, certainly when it comes to the equity trade. All right, so let's get to it. I mean, we've got names like Apple, right, sinking more than 20%. So officially, I guess you could say, in a bear market. Lots of caution on Wall Street. The main U.S. equity indexes, here's a number, have lost $6.3 trillion in value since the March 29th high on worries about that economic slump amid higher inflation and higher rates.
We've got a great voice back with us. Jess Menton is equities reporter for Bloomberg News. She's with us in the Bloomberg Interactive Brokers studio. Jess, the question that I've been struggling with, and I know a lot of our audience has been struggling with, is what exactly is priced into U.S. stocks right now? We've seen significant declines of, 20%, close to 20% year to date on the S&P 500. It's close to 30% for the NASDAQ composite. What are they pricing in?
And especially when you see percentages like that, you'd think, well, how have we not hit some sort of low just yet? So I pulled some data from Bloomberg Intelligence, from Gina Martin's Adams team, and markets are starting to price in a recession. So the level that Bloomberg Intelligence is looking at, it's 3760 on the S&P 500. Coming into today,
it's about another 100 points from where we are.
Right. So coming into today, we were about 4.5 percentages basically away from that, but now with the S&P down almost 2%, we're getting much closer to that. But even with that level, they still don't think investors have priced in that type of low just yet.
So I love that you mentioned Gina Martin Adams. Do the earnings and revenue fundamentals tell you that companies are going to be in a recession as well?
So what's interesting is coming into this earnings season, looking at the end of February up until that point, earnings revisions were actually going up, which was surprising because at that point we had the first start off with the war in Ukraine happening, but there were different outlooks coming out that maybe potentially we could be at a peak in inflation, how that would revolve around corporate earnings. But in the last 2 weeks, because we've gotten the bulk of companies reporting, and especially those big tech companies, now we've started to see those revisions start to turn lower, and especially
still positive.
So still
or
positive,
just not as strong.
They're just not as strong. And even if a company had a stellar first quarter, they might not have had the best outlook moving forward, and that's what's changing some of the trajectories there, and especially not even just technology companies, but consumer discretionary companies are among the sectors that are leading those revisions lower. And we're going to hear from a bunch of them again next week because we have Home Depot, Lowe's, Target. So you'll be able to see more of a glimpse of exactly how healthy is the U.S. consumer right now, because consumer spending has remained strong.
Well, we just talked to the Tapestry CEO, and they came out with earnings. That stock is off the charts today. And she said to us, Joanne Crevoiserat, she said the consumer quite resilient. We've been driving growth above pre-pandemic levels for several quarters at this point. And she said we're optimistic and confident they're spending on technology.
And Kimberly-Clark was a staples company that had also come out a couple of weeks ago and did really stellar. And they even raised their sales outlook outlook for this year. But again, they have different products that are, people are going to still buy toilet paper and Kleenex and Huggies diapers and
my
things
duck
like
mask
that
I wear around, which is made by Kimberly
exactly.
Clark.
And so it is interesting because it's almost as if when I'm talking to strategists, it's not even just a sector by sector basis. So it's not just saying like, oh, all of discretionary might be struggling or staples are going to do really well. It's more about particular management teams and companies and how they're trying to go about combating in the economy right now.
Is the carnage being managed or not? Because I do feel like when you look at deep down and under the hoods of some of these indices, you see stuff like Netflix down 75%. You see a lot of the high-flying tech names down more than that. I mean, Peloton down more than 90%. And I'm wondering if we can, if the major, and even Apple's in bear market territory right now. So I'm wondering if it's actually being masked by, the damage is being masked by the power of the indices. Like if what you're seeing in the S&P 500 is actually how ugly things are.
Well, I think there's some differences there because also, like what we had talked about earlier this week, a lot of strategists were waiting for a lot of that pain to show up in stocks like Apple. And we started to see that at the end of last week. And then we're seeing that again this week. But you're seeing also just these gyrations in intraday trading at certain points. Apple was almost flat for the day and then again took another leg lower. And so you can kind of see these the sellers and the buyers competing right now. But I think from
Twitter was up 3%,
right,
and then it was down 6%.
Exactly. And that's kind
huge.
of the churn that when I'm talking to technicians, they're expecting to see. But when you're thinking about some of these management teams, some companies are still doing well, but it's more of kind of just the overall inflated earnings that were going on during the pandemic and those gangbuster levels that we saw in 2021. When I'm talking to strategists at BI, they were saying overall, and especially looking at technology, it was just very overinflated and that things needed to come down when you're looking at the price to earnings ratio and valuations. And they still think that even what we've seen today and yesterday, they still think there's more room to fall from here.
So we haven't had complete market capitulation.
No,
basically is what they're saying.
When I've talked to Gina's team, they don't believe that's so.
And that's even with consumer discretionary down 30% this year. If you look at information technology, down 26% this year. I mean, more room to go.
More room to go, and really it has to do with they don't feel like investors have fully thrown in the towel just yet. It's a sign that the fact that you're starting to see stocks like Apple getting hammered now, that's a step closer there. But again, those big tech stocks have so much sway on the market that they still don't feel like even more just broad-based there's been enough pain. And they had pointed out how since 2009, each major decline in the S&P 500 of 15% or more saw portions of stocks trading above their 50-day moving average drop to 5% or less, while the 14-day relative strength index fell below 30. And that coming into today, that still hadn't happened yet. And based on some of the losses today, the relative strength index, it's around 30 now, but still they're looking from like a broader perspective. And they feel like when you're looking at those types of indicators, breadth and sort of looking at volume, they still feel like there's got to be more broad-based pain happening.
So Jess, what happens if we fall to 3760 on the S&P 500 and we keep going lower?
So that's a great question. Right now, the key Fibonacci level is 3815, which would be the 38.2% retracement from the COVID lows into 2020. So that's the next key level, and we're getting very close to breaking that. And we're also getting close to hitting that 20% threshold of where the S&P would technically be in a bear market, which would be 38, 37 roughly.
Wow,
but
we are very close.
But
we're at
very
38.68.
close. Very, very close to that. And so then if we break below the 38.15, it's Mark Newton over at Fundstrat who's pointed that out as far as the technical analysis he did. Then he said we could even drop even lower to 3,500, which we would surpass that 37.60 level that BI was talking about as far as what the markets were pricing in. And in BI, when I was talking to Jillian Wolfe over there, she had pointed out that 37.60 right now is sort of the base case scenario for a potential recession. But if inflation numbers, maybe some other data points get even worse, that number could be even lower.
So then we would be below pre-pandemic market levels.
Getting
right?
close. Well,
right, because I do wonder, is that the reset number, like pre-pandemic where we were? Was that a real...
We would have to actually fall even much further below that
for
threshold.
people to feel comfortable in terms of...
It's a long way to go to break to where we would need to be from right before March 2020.
Down to the downside?
Yeah. And but again, those are those technical levels people are watching.
All right, Jess Minton, thank you so much. Appreciate it. This is Bloomberg.
to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in your trading session. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now as ever by our colleagues Carol Massa, Tim Stenovic. We go cross-platform, TV, radio, YouTube to dissect once again risk aversion punning back into this market. We are off 1.8% across every major benchmark, Carol.
Yeah, which makes me kind of scratch my head. Why are investors continuing to move into home builders? I mean, they're up another almost 2%. They were up as much as 6% earlier in the session. This, as we've seen, mortgage rates go above 5% to the highest level since July of 2009. Doesn't quite make sense to me, Tim.
Well, perhaps it might not make sense to people that the ARK Innovation ETF is defying the broader market today and actually getting a bid higher by 1.7% as we see right now. It was down before today for 5 days in a row. 25 of the 35 stocks in it are actually higher today. It's helping being pulled higher by Roblox, Unity Software, Roku, and more.
There is a little bit of buying mentality in some very small corners, whether previously I think GameStop and even AMC, some of the meme faves were getting a bit of a bid, but right now we are turning back red. Look at across your screen. 3,800 is where we are on the S&P 500. We're currently down 63 points, down 1.6%. Similar moves in the Dow Jones Industrial Average from a percentage perspective. We're off by 1.7%, 534 points to the downside. The NASDAQ also off by 1.7%. Your actual, least worst chart, Russell 2000. But remember, this is an index that is off by 30% from its previous highs.
Looking at the individual sector level, really hard to find anything that's in the positive as well today. Some of the big outperformers you could call it a little bit defensive remain. It's real estate and healthcare, only lower by about 0.2%. Everything else, though, classic risk off with materials, financials, technology. The worst performers, you're off as much as 3% on the day.
Yeah, and let's take a look at Apple, because I really think this is really kind of the big story here. The idea that it's down 5% here on the day when we talk about a company that has pretty solid fundamentals here, down 4.8% right now. It's now down more than 20% here from that all-time high, and really emblematic, I think, of some of the shift in sentiment that we've seen over the last few weeks, really few months, if you will. That is the biggest point drag on the S&P 500, and of course, it's the biggest volume mover across all of the tapes. Second biggest volume mover across all of the tapes, AMC Entertainment. Shares were up something like 30%. Why? I don't know. But they're now only up about 2.6% here. We should point out some of the other meme stocks like GameStop were also up 10, 20, 30% here on the day. So make of that what you will, a day that those names get bid and Apple gets sold. Meanwhile, American Express getting sold off after a downgrade over at Wolf Research. A little bit of a concern here about consumer spending and about the potential for a U.S. recession. American Express shares down about 6%. We should point out that downgrade wasn't just American Express. It was all the big credit card companies, including Discover and Capital One. And if you're looking for a bright spot, look at it in Tapestry, guys. Maker coach and Kate Spade. There was a lot of concerns about some of these luxury item makers because, basically all the shutdown in China and the fact you didn't have those consumers traveling the globe. Well, they sold enough things and shoes and bags here in North America to make up for whatever they lost out of Asia. Those shares up 14%.
Can I just say, we talked to the CEO and she's saying the consumer's resilient. They are optimistic. They're spending on technology. So it was interesting amid...
On technology?
Yep, because digitization, people buying digitally.
Let's talk about digitization. Let's talk about digital assets. Let's talk about whether a consumer can remain as resolute and strong as they can if retail gets hit by this. This, I thought, was a great chart brought by Jim Bianco. I saw it on his Twitter feed yesterday, in fact. Look at, what would you guess those two assets are? Walking in lockstep. For our radio audience, I have a white line that is currently the S&P 500 mini futures, and you have a blue line that is Bitcoin. You have seen them basically move in lockstep from a normalized perspective since the Federal Reserve raised rates. Now, this is, as we see, people just see the correlation almost move to one. Yes, we have this ongoing discussion about whether really the pull, the disaster that we saw in the crypto markets overnight, $200 billion pulled out, whether that makes a real impact on equity trading, on retail starting to get out of the riskier assets.
What's the correlation here? I mean, in all seriousness, because we kind of know it gets baked into equities, but when it comes to an asset like crypto, why do you think that correlation got so tight over the last? What's happening?
The Federal Reserve. I'd say risk assets are all being puked up across the board.
I think Sebastian Gailey over at Nordea Asset Management put it really well in times of stress, and I want to use that word carefully because this is not 2008, this is not 2000, but when there are volatile times, you tend to sort of get, as Caroline was saying, a classic risk off, and we did do the math on the correlations. It's 0.8, Romain, which is very, very high.
Thank
well,
you.
is it just investors, right, kind of starting to bail on everything? Although we just talked with her, I'm going to ignore you guys. We just talked with her, Jess Benton, and she said, we haven't seen full capitulation. And what's interesting, I mean, you look at where the S&P 500 was just before the sell-off back in March of 2020. It was 33.86. We're still at 38.76.
Yeah.
So do we need to get back to that level to be indicative of the current market environment?
And to your point, Carol, I mean, we were just talking about correlations. Look at single stock correlations, which are usually kind of a harbinger when things have really gone out of whack. We're still at something like a 0.5 on single stock correlations on the S&P 500. You think back where we were back in March of 2020, or in the big sell-offs back in 2016, and of course in 2011 when you had the big AAA downgrade of the U.S., the correlations were like, at 0.8, 0.9, and of course they exceeded 1 back during the global financial crisis.
All right, well, I'm just going to say when Citigroup starts talking about bubble territory, it makes me a little worried. They do talk about the volatility we're seeing in the markets. Citigroup strategists putting out a note, a few of them at play here, Robert Buckland and Dirk Willer over at Citi. They wrote, when a major equity market bubble is deflating, it may undermine most global equity markets, not just the one that is deflating. This would suggest that a potentially deflating U.S. bubble should be negative for equity risk more broadly. And, I feel like as day by day goes by, Tim, we see this playing out.
Yeah, they said something in their note that reminded me of a conversation we had with Chris Ailman at Milken last week. They said, expect subpar returns from here, and they recommend cheaper so-called value stocks. Chris Ailman told us we've got to moderate our return expectations over the next decade based on the difference that we saw over the last 3 years.
Did you notice how in that Citi note they said that the bubble actually started in October of 2020?
I wish they would have told us then.
Which
right?
was like, that's
Hindsight's a beautiful thing.
Well, you think about
It was
where
a
we
bubble
are.
that blew up for a long time, though.
Well, and in part because of monetary stimulus. We've talked
Right.
a lot about the fiscal stimulus. We've talked about at least the health of the consumer this time around. The economy, of course, is in much different shape than it was in March of 2020, but you don't have all of those tailwinds behind you. And of course, you have a few headwinds as well.
And let's think how global those headwinds are as well, because this is an inflation story, a PPI print that we get once again here in the US, that we see inflation riding in a lot harder than we expected over in China. You're seeing Europe getting really beaten up, talk of recession there as well. This is one where the All Country World Index comes into play as well, down, down, down.
But this is where, again, the CEO of Tapestry talking about strength in the U.S., strength in Europe, strength in Asia, and even at the beginning of the quarter in China, but then as the COVID lockdowns, that started to come undone. So, I'm trying to make sense of what we're seeing, right? More broadly macro versus what some of these CEOs are saying.
Interesting.
Yeah.
Okay.
All right, we're going to continue. We'll be back in less than an hour's time. We will count you down at the closing bell on TV, on radio, and YouTube. Beyond the Bell coming your way on Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Radio, Bloomberg Business Week. Carol Master along with Tim Stenovic. I have to say, we've just been showing that chart to me in terms of what we are seeing. We could have a long ways to go if we want to go back to 2020 levels.
Yeah, I can tell that
the S&P 500.
Those technicals really got you thinking and got you pulling out the charts. In the meantime, let's get a check of world and national news. Nancy Lyons is standing by in D.C. Hey, Nance.
Thanks, Tim. 5 lawmakers with ties to former President Trump are being issued subpoenas to testify before the House committee investigating the January 6th attack on the U.S. Capitol. Bloomberg's Washington correspondent Joe Matthews says those being ordered to appear include GOP leader Kevin McCarthy and Republican Congressman Jim Jordan of Ohio, Scott Perry of Pennsylvania, Andy Biggs of Arizona, and Mo Brooks of Alabama.
It has a large amount to do with not only the fact that they did not show up for interviews, but their names keep coming up in other testimony. And that's what finally led members of this committee, with only 5 Democrats and 2 Republicans making these decisions to send the subpoena.
You can hear more with Joe Matthew on Bloomberg Sound On at 5 p.m. Eastern Time on Bloomberg Radio. For the second time, President Biden convened a virtual summit of world leaders to deal with the COVID pandemic that has now killed 1 million Americans and an estimated 6 million worldwide.
The president said this is no time to lose momentum in creating the health infrastructure to vaccinate and treat more people.
The United States will share critical COVID-19 technologies that are owned by the United States government. We're standing up a new pilot program to expand access to rapid testing and antiviral treatments for
Connection
people
lost.
in harder to reach areas.
President Biden hoped Congress would have set an example by appropriating more money to help the world combat the pandemic, but it hasn't yet happened. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nancy, thank you so much. Carol Massar along with Tim Stenovic. So the cover story, Bloomberg Business Week, the new issue just out on newsstands, online at bloomberg.com/businessweekend on the Bloomberg terminal. It's about the return of the company's longtime CEO at Starbucks, along with a rise of a union movement among its baristas.
We're talking, of course, about Howard Schultz. The story by Josh Idelson. Check it out. It's the cover story, as Carol mentioned, of the new issue of Business Week magazine. It's available on newsstands, on the Bloomberg, and at bloomberg.com/businessweek. Josh is labor reporter for Bloomberg News. He joins us on the phone from San Francisco. With us here in person is the editor of Bloomberg Business Week, Joel Weber. He's with us in the Bloomberg Interactive Broker Studios. Joel, I want to start with you because this is the third time that Howard Schultz has been at the helm of Starbucks. What is the Starbucks that he found when he returned just about a month ago as CEO?
The surprise, I think, that probably awaited him was one that he was not probably familiar with from his other stints, which was this newfound power that labor has. And Starbucks, which I found really surprising, the workers of Starbucks have, for all of this talk about unionization sweeping the country right now, Amazon being one that we've talked about extensively, all of those roads lead back to what has been happening at Starbucks. And Starbucks has been really, the workers of Starbucks have been a galvanizing force that a lot of other workers in corporate America have been inspired by. And Josh, to his credit, saw this long ago and started reporting the heck out of it and going to as many states and talking to as many workers who were behind the scenes of that union effort. And so what you really have here is a CEO who helped build this company into a global brand, comes back to it and has found that the workers aren't buying that same vision that he had laid out long ago. And you see this tension between the workers and Schultz, and it even culminates with the workers being invited to the White House and the company sort of saying, "Hey, we got cut out of this." So Josh, what do you're somebody who follows labor obviously very closely. I think Josh is probably as good as it gets in terms of labor reporting in this country right now. And what really distinguishes the Starbucks story for a wider audience here?
So in recent decades in the United States, it's pretty much unheard of for workers to win a labor board election at a company as prominent as Starbucks, where there isn't a union already and there isn't some kind of deal between the union and the company to play nice. And that this union not only won that first election in Buffalo, but has now won at 60-some stores and is petitioning to unionize hundreds of Starbucks cafes around the country, is a movement with little precedent in the 21st century United States at a big company. And it is being done mainly through workers mentoring each other, not just workers organizing their coworkers, but workers training other workers to train other workers to train other workers to organize their coworkers. And that is how, as one worker put it, this ultimate group project has spread so quickly and has proven so difficult for Starbucks, despite all the resources at its disposal and the goodwill that it's had to stem this movement from growing and spreading further.
There are a lot of directions I want to go, Josh, but one question that continues to stick out to me is, Starbucks as corporate is pushing back very aggressively when it comes to these unionization efforts on an individual level. Even before Howard Schultz came back, remember he flew to Buffalo to meet with those unionizing employees. What is at stake here for Starbucks? If there is widespread unionization across U.S. stores here, to what extent does that affect Starbucks business?
Well, there are two big reasons that companies tend to resist unionization, and one is money and the other is power. Of course, for the union to prove its worth to workers, it is going to need to show that it can extract things from Starbucks that workers wouldn't otherwise get, and some of those things are going to cost money. But the other reason that companies fight unions, and that they often are willing to spend a whole lot of money both on anti-union consultants and on making improvements to try to mollify people, is that they don't want to give up that control over how the business is run. And Starbucks for years has bragged, including Howard Schultz has bragged, that there's an empty chair at the board meeting that represents workers' voice. So now you have workers saying, why is the chair empty? Put us in the chair instead. And in fact, in Buffalo, they're in collective bargaining negotiations proposing that Starbucks should have to put a representative of the workers on its board. And so for Starbucks to become substantially unionized would mean that Starbucks executives have less unilateral ability to decide what the business model should be, what the rules should be. And that's part of why the stakes here are so high.
Josh, what happened at the company? I thought this was the one where they paid their workers well. They had nice benefits. I mean, this is something that Schultz kind of took pride in as you report. What happened?
So workers would answer that question in two different ways. And one is to say it's not as dreamy as it may sound. Even the $15 minimum pay that the workers will be guaranteed by August is not a living wage for someone with a child in a city like Seattle. The staffing issues have been egregious at times, especially during COVID, and the handling of COVID disappointed some workers and left them feeling betrayed. The other answer they would give is that it's not enough to be better than other fast food companies, and that they believe they should have more say in their working conditions and therefore in their lives, and that there is no one particular thing that Starbucks could solve that would make them go back to being okay with the company having all the control.
And where do things stand with Schultz? Because as you write, this is not he's not permanently CEO right now, right? He's just back on an interim basis. So where will this dispute go?
That's what they've said. There's supposed to be a permanent announcement in the fall. There are some people hoping that Schultz stays on, but it is a fight that is deeply personal for Howard Schultz. This is his baby, and he has come back and made these personal appeals to workers, sometimes emotionally, intensely, as we see in the rooms that we go into in this story. And so this is not a struggle that he's going to be able to shrug off, whether he's in the CEO seat or not.
And some other companies watching this very, very closely. Josh, thank you so much. Really appreciate it. Josh Idelson, he's labor reporter at Bloomberg News. This is the cover story of the new issue of Bloomberg Business Week on newsstands right now, on the Bloomberg, and of course online. Joel Weber, he is the editor of Bloomberg Business Week magazine.
Well, under 45 minutes to go until the close of trading here in the United States. Let's get an update from Charlie Pellet.
Thank you very much. And here's what's going on. Lower across the board for U.S. equities. Just talking about Starbucks. Its shares right now down by 0.7%. To put that in context, the S&P is down 1.5% right now. The Dow also down 1.5%. We've got NASDAQ down 1.4%. NASDAQ down 158 points. The NASDAQ 100 index down 1.6%. S&P down 57. The Dow lower now by 483 points. Key takeaway, the Dow and the S&P both down by about 1.5%. 10-year yield 2.82%. Spot gold down $29 the ounce, down 1.6%. 18.23 the ounce. West Texas Intermediate crude up 0.8%, 106.63 a barrel. Brutal volatility continues to grip financial markets, roiled by the threat that restrictive policy by major central banks will throw the global economy into a recession. Data this morning suggests Fed officials will keep tightening monetary policy. TikTok is being blamed in a lawsuit for the death of a 10-year-old girl who allegedly participated in a viral stunt in which people choke themselves until they black out. Among the names reporting after the closing bell today, we'll be hearing from Joby Aviation, shares up 5.2%, Toast Inc. up 10.6%, Figs up by 2.1%, and Houlihan Lokey up now by 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, Tim and I were at the Milken Institute Global Conference last week. We talked a lot about the markets. Big topic touched on in so many panels and conversation was ESG. So we're going to get into into that along with the macro environment with our guest. Great to be talking once again with us is Dave Gitlin, Dave Gitlin, Chairman and CEO of Carrier Global. You know the company for making HVAC systems, refrigeration, so many different things that certainly affect all of us on a daily basis. And he's here in our Interactive Broker studio. How are you?
I'm doing great. Yeah, thank you for having me, Carol.
It's great to have you here, Dave. And I do think about, Tim and I were just talking, I mentioned when you walked in that we're watching the volatility in the markets, and we're seeing so many asset classes come undone, it feels like, but in a controlled way. And yet, we just talked with the CEO of Tapestry. She was calm, said consumers are spending. She was optimistic. How do you see the environment, and how do you kind of cross that with what we're seeing in the financial markets?
We feel the same way. We feel very confident in where we are and where we're going, and a big part of it has to do with the secular trends you mentioned, like ESG, but we looked at our first quarter orders were up 10%. Our backlog is up over 30% versus last year. So demand has continued to be very strong.
Is backlog up because of supply chain problems or just demand?
Well, partly. We have some overdue because of supply chain, but it's really because of demand. Our orders have been strong multiple quarters in a row. They continue to be very strong. We have obviously a watch like others on China, but demand in our residential business, large commercial, our light commercial business, which is HVAC for things like K through 12, very, very strong in the United States. Retail with people coming back. So we do see very, very strong demand right now.
Would you say that the primary driver of demand is reopening, that desire for businesses and schools to make sure that they have clean and healthy air for the people who are in their buildings?
That's a big piece of it. If you take K through 12, it's a vertical that's traditionally been starved for capital. And all of a sudden in the last year, they've been given $190 billion
by the U.S. government.
States. Yes, by the U.S. government. And it comes in three ESSERs. The last ESSER is $120 billion that's going to be spent over these next few years, and a good chunk of that's going to go to HVAC because it's not only to build more energy efficient, more sustainable type solutions, but schools are very aware of the criticality of the health of the indoor environment. And that's what COVID has really done, is shined a light on the criticality of having safe and healthy indoor environments. If you're in a school system, it not only helps prevent the spread of airborne illnesses like COVID, 1 in 13 kids have asthma. And then you also look at kids test better when you have lower CO2 levels. So there's multiple benefits, and a lot of that spending is going. So our K through 12 orders in the first quarter are up 50%.
Wow. So are we all, Dave, looking at things differently post-pandemic because we understand that air quality really makes a difference? Or is it just something that, okay, we were worried about in the pandemic and we're not so worried now? Or are you seeing that kind of as a sustained concern and then a sustained upgrade?
100%. And I think what's happened is you can see there's a certain amount of anxiety when people go into very crowded indoor environments where you're shoulder to shoulder. So we're very confident that it's sustained. If you take bottled water in the United States, people spend $36 billion on bottled water when it's free. And what's happened is people are sensitized to that's a safer way to drink water. What's going to happen with health air is because it's invisible, people don't know whether or not it's safe. Our job is to make air visible, and what we're selling now is a new digital platform we call Abound, which can make air visible. It's an aggregated scorecard of whether or not the air that you're breathing is safe. And our goal is to make that ubiquitous. So when you come into Bloomberg or you go into a restaurant or you go into a school, you can see it in the Atlanta Braves games in Truist Park. It's an aggregate score that tells you are in a safe and healthy indoor environment. So that's our goal, to make it sustainable, is make it visible.
But this only works for HVAC systems and filtration systems that are Carrier systems, right?
Our system can work with others as well. Like, it can overlay with anyone's building management system or anyone else's equipment. It's a digital tool that we've launched in partnership with AWS to really make it so, in any where we can attach the sensors and collect the data, it looks at CO2 levels, particulate matter, radon, TVOC. So it's a way to kind of get data and make it visible so you get confident to go back indoors.
How much of what you're doing is upgrades of existing systems, Dave, versus what is new construction? Because I'm trying to get an idea of construction that's going on right now.
Well, in the large commercial side, it's 70% new construction and 30% replacement. And if we look at that space, we look at the Architectural Billing Index, because that's a 6-month leading indicator. People work on architectural designs in advance, of course, of construction. And the ABI, you want that to be north of 50. It's been north of 50 for 14 months in a row. So there is demand for large commercial buildings. In the residential and light commercial space, it's the reverse. It's 80% replacement and 20% new construction. And residential for us was up over 20% in the first quarter. Light commercial, which is things like data centers, retail, K through 12, that was up over 30% in the first quarter. So very strong demand in that particular vertical.
All right, I'm going to go back to you. You sound positive and optimistic. So I'm trying to figure out where we are in this economic cycle.
You know, I think there's this anxiety that is very understandable because obviously with the inflation we've seen, people know that leads to rate increases, which typically slows an economy. So you can understand the anxiety, but when you kind of go back to things like secular trends that we know there's going to be demand for things like more energy efficient HVAC systems. So in Europe, our orders for heat pumps, for commercial heat pumps, where we're the market leader, they were up 30% in the first quarter as Europe weans itself off Russian gas. You know there's going to be more demand for systems like heat pumps. You know that if your air conditioner fails when it's hot, it's going to be replaced. You know, people are spending more time at home.
Our whole AC
hopefully Carrier.
heat system.
No,
Hopefully
I think
it was.
So yeah,
Sorry,
it's all good.
Don't put me on the spot like that.
You could help the quarter, Carol. So we.
But what's interesting, what you say is like it was an old system, 20 years or so, and it's much more efficient. Like it's just the technology continues to get better and better.
And we see people,
and the government require it.
Yes, and governments incentivize it, but people are also mixing up. You know, because people spend more time at home. They don't want it when their air conditioner goes off and on, you know, makes that sound. So they're actually going for variable speed, more higher end equipment. So to your point, there is this juxtaposition with anxiety about the future and some secular trends like ESG and healthy indoor environments, a rising middle class globally. Only 7% of people in India have air conditioning, and it's a pretty hot country, you know, 1.4 billion people. So you can see that these forces coming together that's driving demand. Our challenge,
we both
honestly,
want to ask you questions.
Please go ahead, Tim. Yeah,
So climate change, what signs are you seeing of like you're putting systems in places you never thought you would put air conditioning, like that just speaks to kind of what's going on in our environment globally?
Yeah, you know, what's really encouraging is the continued trend around heat pumps in particular for HVAC systems. So in Europe, almost all new construction is going to heat pumps in Europe for residential. We're seeing in the United States, states like South Carolina, we look at their heat pump, where they sell heat pumps with connected to their split system versus a cooling only. They sell more integrated heat pumps than they do cooling only. So the demand for heat pumps in the United States and globally is going up exponentially. More energy efficient solutions. In the United States next year, there's going to be, the entire country is going to a switch to higher SEER units. In the South, 14 to 15 SEER, North, 13 to 14. So governments globally are incentivizing their populations to drive more energy efficient solutions. And that's what we do. So that's why there is this overall anxiety. But when you have things that can make a meaningful impact on climate change, that there's going to be demand. If there's going to be things that impact health and wellness, there is going to be demand there.
There is this overarching anxiety, but at the same time, you do sound really optimistic, as Carol said. But there is a lot to be concerned about. We've got concerns about the recession here in the United States. At Milken, we heard a lot about a potential recession in Europe and concern about the customer in Europe. What keeps you up at night? What concerns you?
Right now, our biggest challenge is keeping up with the demand. So clearly, we understand the concerns around recessions. And, you know, we all kind of read about it, and you can understand some of the underlying reasons why there is that anxiety.
Nobody's canceling orders?
No one's canceling orders. Our demand has, you know, our biggest challenge right now is truly we have chip shortages. We're working around the clock to rectify those. But as we operationally perform, we're taking share because we're able to support our customers better than some of our peers. We are managing inflation. We came into the year saying that we would get a 5% price increase, $1 billion on $20 billion of sales, in anticipation of $1 billion of inflation. The only good news with the anxiety that folks have about the economy is some of the commodities have recently been coming down, copper, steel, aluminum. So if we can keep prices at the raised levels that we've done, and if we get some relief on some of the commodities, that should drop through with some margins.
Dave, based on what you're seeing in terms of commodities, I thought that was a really important point. Do you think we have hit peak inflation?
It's hard to call that because every time we feel like it's peak inflation, the next quarter's worse. So I could tell you that we have seen over the last few weeks some relief, but it's really hard to anticipate what's going to happen a few quarters from now. You know, we've been able to now stay out in front a bit. So we've been very, very aggressive because last year we chased inflation all year with pricing.
Yeah.
This year we said we are not going to chase inflation. We are going to get out in front from pricing. We had good pricing in the first quarter, and we're very confident that we will do very well on the pricing side this year.
Dave, very briefly, 15 seconds. Are high energy prices actually good for you because it compels people to upgrade their systems to more efficient ones?
Yes, that does drive demand for more energy efficient solutions, which is actually good for our business.
It's the only business where apart from oil and energy companies, right?
But you have to think about that, right? You've got to really think about how all the different markets. Dave, thank you so much. Really appreciate it. Dave Gitlin, Chairman and CEO at Carrier, joining us here in our studio.
Let's get a check of the markets as we are a half hour away from the close. Hey, Charlie Pellet.
Indeed, lower across the board, but well off session lows right now. Speaking of energy, crude is up 1%. WTI, West Texas Intermediate, up $1 a barrel now, 106.75. Natural gas up 1.2%, 7.72 per million BTUs. 10-year yield 2.84% right now. Brutal volatility continues to grip financial markets, roiled by the threat that restrictive policy by major central banks will throw the global economy into a recession. This morning, prices paid to producers rose more than forecast in April. The S&P down 41 right now, lower by 1%. Again, we are off session lows. The Dow down 394, lower now by 1.2%. NASDAQ is down 97, a drop there of 0.9%, and that 10-year yield 2.84%. So it is a down day on Wall Street. Victoria Green is a founding partner at G Squared Private Wealth. She was interviewed this morning on Bloomberg Radio and Television.
It's 100% a bubble that's bursting, and I hate to pick on the Cathie Wood-esque stocks, but the ARK Fund is like the poster child for what this bubble is about. And this bubble is hitting the stocks that really don't have current earnings. You know, you're investing in future innovation, and those are the stocks getting hit the hardest. You know, you look at, say, a Coinbase, a Teladoc, a Peloton, a Zoom, all of the pandemic darlings that are now kind of pandemic duds.
She mentioned those so-called pandemic darlings on a down day for stocks. All 5 of the stocks she mentioned are now higher. The ARK Innovation ETF up now by just about 4%. Coinbase up now by 4.5%. Teladoc is gaining by 5%. Peloton up by just about 8.8%. Zoom the exception now. We've got Zoom Video Communications falling now by 0.1%. Again, recapping the Dow, the S&P, and NASDAQ all trading lower, with the S&P down 42, drop there of 1.1%. 10-year yield 2.84%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Well, season 4 of Bloomberg's Paycheck podcast making its debut, looking into global economic inequality 2 years into the pandemic. The new episode, by the way, dropping today. Here's a little snippet.
For our 4th season, the Paycheck podcast is going to 7 countries to try to understand how those variables affected economic inequality. In many ways, the pandemic has made inequality much worse.
So this pandemic, we're witnessing the biggest increase in billionaire wealth since records began. And a billionaire was created every 26 hours during this pandemic.
But not everywhere or everyone has felt the pain equally. Some places and people have been hit particularly hard.
For all Brazilians, the cost of living is really getting unbearable. And it's the poor and the once booming middle classes that are bearing the brunt.
All right, that, of course, the incredible voice of our own Bloomberg News Equality Team leader, Rebecca Greenfield. She is co-host of the Paycheck podcast. She joins Tim and myself here in our Interactive Brokers studio. How are you?
I'm doing good. How are you?
Doing well. So tell us about season 4.
Yeah, so the Paycheck broadly is a podcast about money and inequality. You know, we did the gender pay gap.
Nothing to talk about there.
We did the racial wealth gap. So this year we were sitting down, and it was going to be the 2-year anniversary of this pandemic. And it felt like a good time to take a minute and say, how was this major event? There's never been a bigger event in our lives, it seems, affected economic inequality. And so we decided to take a global look, and we go to 7 different countries over 8 episodes, and to see how things shook out, because it felt inevitable that we would come out of this more unequal, and that's not actually what happened everywhere.
We talked a lot about the increase in wealth that we've seen with billionaires throughout the pandemic, but what are the other metrics that you looked at when it came to quantifying just how much more unequal we've become in the last 2 years?
Yeah, that's a big data point and kind of the easiest one to point to. This pandemic has produced a lot of wealth at the very, very top. The U.S. has particularly good data about that. Next week is our episode specifically about the U.S., but Ben Steverman, the wealth reporter here, touched on that in episode 1. And just looking at wealth and income for people in the U.S. in 2021, which is kind of the most recent data we'll have, shows that people in the bottom 50% actually ended up gaining wealth during the pandemic, and their incomes went up too. And that's a pretty surprising story. So we kind of use those kind of data points in different countries where the data is available. It's very different in different places to try to tell these stories. Sometimes we're looking at female labor force participation. In one episode, we look at maternal mortality rates. Another episode, we look at spike in child marriages. And they're just these little things you can look at to try to tell this bigger story.
What about when you compare emerging versus developed?
Yeah, I mean, that's a big difference in this wealth story globally. In the last few decades, there has been a real good story in emerging and developing markets that a lot of people have been lifted out of poverty. China has a huge growth of the middle class, and that's been a big trend. But as we learned, that trend was maybe slowing a little bit, and then the pandemic really set a lot of those places back, places that didn't have as much money to pump into their economies, or when their economies stopped completely, it just really devastated things. So that's another thing we look at, particularly our episode in Kenya looks at that. Really saw a lot of gains, particularly with educating girls and women, lifted a lot of people out of poverty. So how did the pandemic play into that? So yeah, we're really all over.
I want to go into a little bit about how the sausage is made here, because I'm wondering from a geographic standpoint how you chose to tell this story through the 7 countries that our reporters visited.
Yeah, so one amazing thing about Bloomberg is we have reporters all over the place. We have editors all over the place. And so we relied on that strength. So we went out to the newsroom and said, what are some stories you're seeing? So we got, we have reporters in India who are telling one of my favorite stories of the season. I don't have favorites.
One of your favorites.
One of my
so
favorites.
One that stood out for me.
One of my 8 favorites. They're all my favorites.
Nice.
We also wanted to, be in every region. We wanted to show developing countries, developed countries. Latin America is a very specific place where it has some wealth, but there's a ton of inequality. So that felt important. So we couldn't go everywhere, but we do, we have Singapore, India, US, Spain, really Kenya, trying to hit kind of every different part of an inequality story.
As we are, I hate to say we're coming out of the pandemic because we know we're far from over, but it does feel like we're kind of getting on the other side of it in some ways and certainly learning how to deal with it.
Or at least we're acting like we're on the other side of it.
We're back at work and there are no masks or barriers up for the most part. But I do wonder, Rebecca, in you and your team in the coverage, do you feel like there are some things when it comes to equality or inequality, the gaps that we're going to come out better overall, more broadly? Some new trend lines that are better and more positive?
Yeah, like I mentioned in the U.S., just the gain of the wealth of people at the bottom. I think the question is can it continue after the pandemic? A lot of that was from a really robust government response and then this really tight labor market. And I think, so that's something that's very different. The last economic crisis in 2008, it was the complete opposite. The rich got richer, the poor got poorer. So that's one good news story. We have it's more good news than you would expect. So even the Kenya story, for example, there was a huge setback for girls who were out of school. It was really devastating. We actually based the episode on a Business Week story that was already published earlier this year, called The Lost Girls of COVID. It's a really great story.
We did, we talked about it.
So, but this is a follow-up to that and kind of shows how the girls are seemingly bouncing back a bit faster because of some infrastructure that was there before. And so it's not a great news story. There's a lot of devastation, but it's not as bad as people expected.
All right, so where can we find this podcast?
Wherever you listen to podcasts, Apple Podcasts, Spotify, The Terminal.
But you have maybe you do have a favorite podcast.
No, never.
platform.
No
The
favorites.
Terminal.
No favorites. Yeah, The Terminal. Definitely where I listen to podcasts.
Well, we highly recommend it. We've covered it before, and it's really just incredible, the stories and the places that you take us with this. The Paycheck Podcast, Bloomberg News Equality Team Leader Rebecca Greenfield. She is the co-host of it, so do be sure to download it and check it out. Rebecca, thank you.
Let's get to world and national news. For that, we go to Washington, D.C. to check in with Nancy Lyons. Hey, Nance.
Thanks, Tim. President Biden has been speaking virtually this afternoon with baby formula manufacturers and retailers in light of that nationwide shortage brought on by a safety recall and transportation challenges. He asked them to boost production. He's also asking the FTC to crack down on any price gouging. Well, the shortage of baby formula is forcing some parents to look for other options. Brian Dietmeyer is the Senior Director of Public Policy at the National WIC Association.
Stay away from things like homemade infant formula recipes or efforts to dilute your formula or to introduce cow's milk before age 1, because all of those practices we're seeing on social media, and it does have health risks for babies.
Dietmeyer says his organization is working to crowdsource supplies of formula for those in need. The Supreme Court met today for the first time since that draft opinion leaked, showing support is there to overturn Roe v. Wade. All 9 justices were on hand for this morning's arguments. Overturning the ruling on abortion rights will make it harder for doctors to treat women who have suffered a miscarriage.
Doctors say stricter laws make it harder for women to get the most medically appropriate treatments for miscarriage because the procedures to remove a failed pregnancy are the same as those for an abortion. So without federal abortion protections, doctors might not be able to offer such treatments, and doctors in training might not ever learn the full spectrum of care for a miscarriage. And that could put the mother's health, future fertility, or even her life at risk. It's not just a theory. Physicians say they're already seeing such problems in states with stricter laws. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nancy, thank you so much. Nancy Lyons, she is in our 99.1 newsroom in Washington, D.C. We do have stocks coming off their lows of the session, still down about 0.6% on the NASDAQ. So we've definitely seen a bounce, a significant bounce off some of those lows.
Yeah, it's interesting. I talked about this during the simulcast, but the ARK Innovation ETF, ARKK, is the ticker. It's actually higher, defying the broader markets today. It's up by more than 4.3%. And it's interesting because it was down for the last 5 days in a row. A big part of that has to do with the decline in what we saw with Coinbase, Unity Software. Unity's higher today. And ARK was just getting destroyed to levels not seen since before COVID.
Right, and there was a recent story, was it last week, that they were actually starting to see, I think, inflows.
They've been seeing inflows throughout.
Right.
Yeah, I mean, that's been sort of the theme, I think, with this, is despite the declines, you're still seeing investors
money coming in,
bet their money on Cathie Wood and ARK.
So it is kind of interesting. And, Cathie Wood has certainly been on our air. Tim and I have had conversations. I've been having conversations since she began. I mean, she does consistently stick to this 5-year investment horizon. And she would say that when you're seeing some of this selling, that's when you can, some of your top picks go into it at a cheaper level. And this is where I think we're all, as investors, trying to understand what is the bottom here when it comes to either individual names or the broader market. Because at some point, you do look at these companies fundamentally and say, okay, it's a lot cheaper than it was a few months ago, and is that a buying opportunity? Do I get in?
Well, that is exactly what ARK is saying. Brett Winton, ARK's Invest Director of Research, was on Bloomberg TV yesterday and said, quote, "The market is not pricing assets based on fundamentals. From our perspective, you're getting amazing sales prices on innovation assets."
And if you believe this is where the future goes, and every company, and I feel like CEO, including Carrier that we just talked with, that comes on, Dave was talking about, there's innovation going on, technology driving so much, and so many of the established industries are going through changes. So, and that's certainly what Cathie speaks to. All right, you're listening to Bloomberg Business Week. I'm Carol Masser, along with Tim Stenovec. We're going to count you down to the closing bell.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters. I'm Charlie Pellet. Looks like we have put in the lows for the day. 13 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ do remain lower, but not as bad as things were. We've got the S&P now down by 31 points, a drop there of just about 0.8%. The Dow's down 283 now, down 0.9%. NASDAQ lower by 82 points, a drop there of 0.7%. The NASDAQ 100 index does remain lower by 1%, but we have seen a turnaround for the Russell 2000. It is up now by 0.7%. 10-year yield 2.84%. Spot gold down 1.5%, $18.24 the ounce, while West Texas Intermediate crude is up 1%, up 104 a barrel, 106.76 on WTI. Prices paid to producers rose more than forecast in April. The data suggesting Fed officials will keep tightening monetary policy. Again, that 10-year 2.84%. S&P off-session lows down now by 26 points, a drop of 0.7%. A number of companies will be reporting after the close of trading today, including Joby Aviation, up now by 7.3%. Toast Inc. will report up now by 10.4%. Figs, it is up by 3%. And we'll also be hearing from Houlihan Lokey. It is up now by just about 1.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg editorial board. With an eye on the midterm elections, Republicans have highlighted a surge in illegal crossings at the southern border to attack President Joe Biden's handling of immigration. Their criticism is not unwarranted. Biden has largely failed to implement a coherent border policy. This, in turn, is making it harder to create the immigration system the country badly needs. Biden should compromise on lifting pandemic-era border restrictions and press Congress to commit more resources to strengthen border security. After containing the challenges at the border, Biden could then begin to forge a bipartisan coalition to reform the legal immigration system. A Canadian-style system that prioritized highly skilled immigrants would encourage economic growth, and polls show that it could command public support. But for that to become a reality, the U.S. government must prove it can contain illegal immigration first. This editorial was written by the Bloomberg editorial board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, we have about 10 minutes left in today's trading session. Man, talk about a volatile one once again. Up, down, up, down. Yeah, it's a seesaw market is how I'm going to describe it. We are definitely off our lows, as we just heard from Charlie. And really interesting to see investors coming back into the market. And I think this is the trade we continue to see, Tim, as investors try to figure out, at least on the equity side of things, where is the bottom?
Yeah, that's exactly what we talked about with equities reporter Jess Menton a little earlier, sharing with us some key technicals. But we are above those technicals, at least as of today. Let's get into it with Chris Zaccarelli, the Chief Investment Officer at Independent Advisor Alliance. Chris joins us once again on the phone from Charlotte, North Carolina. Chris, how are you?
Doing well. Thanks for having me back.
Are you doing well? This market's been pretty tough for a lot of people.
Well, I mean, I think the market has been a challenge, absolutely, and clearly we've had a lot of volatility, but I think it's not completely unexpected, given what the Federal Reserve needs to do to get inflation under control. We can't say we're surprised, but obviously we'd love to get through this period of market turbulence as quickly as we can. Unfortunately, there's nothing we can do to control it, so we just have to ride through the volatility.
We're in the fifth week of that market volatility, so here we go, 2022. What is it out there on the horizon fundamentally that maybe gives you hope that you see some sign of a conclusion at some point later on this year, or do you feel like the visibility is not so great right now?
Well, I think we're definitely in a bear market. Clearly we're not in the technical definition of 20% down from the all-time high on the S&P, although we continue to get
We got really
closer.
close today. Yeah.
We did, absolutely. But ultimately we think about it in terms of just kind of qualitatively. The idea of a bear market is that investors just see everything as glass half empty, and that's clearly where we are. Now, some things that would give us confidence on the positive side of things is that, the consumer still has a lot of cash on their balance sheet. Companies are equally pretty well capitalized. And so we're heading into a more difficult time where the Fed is raising interest rates, but the economy, for all intents and purposes, with the exception of obviously inflation being a challenge, is still on pretty strong footing. So for that reason, we feel pretty confident that you're not going to see a recession this year. Now, next year or the year after, obviously, that's anyone's guess. And unfortunately, as the Fed begins raising interest rates, the probability of recession increases. But as far as from a positive point of view, the idea that we're not going to have a recession this year could potentially provide a floor under the S&P, and we won't drop through that 20% peak to trough drop that you typically see with a bear market that accompanies a recession.
Yeah, Vince Signorella writing, the Fed is not, as critics like to say, behind the curve. It is actually way ahead of it, and as such, on the verge of a major policy mistake. So he's certainly concerned about the Fed overdoing it. You mentioned, Chris, consumer balance sheets, and yes, they are flush and have been flush because of all of the government stimulus, but that's not going to last forever.
Yeah, that's absolutely right. And actually, if you think about it, part of the reason why we have the inflation problem that we have now is because there's so much cash in the system, whether that's from the federal government spending or whether that's from the Federal Reserve's balance sheet. Clearly all of that fiscal and monetary stimulus provided the preconditions such that, supply chain issues and the other things that eventually started the process going, not to mention the war in Ukraine. But ultimately, with all that cash, it does set the seeds, or does set the tone for inflation. And so at some point, consumers are going to need to pare back on what they're purchasing. They're going to have to make harder decisions. Ultimately, it just won't be a blanket statement that the entire stock market should go down. You're going to have to pick winners and losers. You're going to have to look at those companies that are likely to have pricing power and to be able to make it through a recession if there is one. And I think that's what we're looking ahead to, not just watching the market as a whole, but looking at, a market of stocks instead of just a stock market.
Well, Chris, help us understand how you're thinking about opportunities right now. Are you putting cash to work, and where are you putting cash to work?
So we've raised a good amount of cash earlier this year in the concerns that we'd have a lot of volatility. We've been slowly putting cash to work. I think unlike in 2020 where there was a V-shaped recovery and it would have been very difficult to put cash back to work, this has obviously been a slower process. And as Carol mentioned, we're 5 weeks into volatility. We think this entire year will probably be full of volatility because ultimately the volatility is being caused by uncertainty around inflation, uncertainty around Fed policy, and then ultimately uncertainty about growth. And we don't think any of those things will resolve in the near term, so there's going to be volatility. We do think there's opportunities for the market to bounce. As I pointed out in the notes, I think there's been a lot of bear market rallies that have been very sharp. As far as the things that we're slowly been putting back into the market, we've been looking at a little bit more defensive positions in terms of healthcare providers or things that we think will make it through a recession. And we've added a little bit more cyclicality as energy and some of those commodity complexes has sold off in recent days on growth years. We've added a little bit more to our portfolio because we think inflation will be a little bit more persistent than people are thinking, even though the Fed is raising rates.
Not hearing any of the high-flying tech names.
No. We reduced a lot of our tech exposure last year. We definitely were concerned not only of valuations, but also of the idea that, tech and some of those longer duration assets, so to speak, were doing very well in a low interest rate environment, and they've had tailwinds for over 30 years. But we did think we were going to move into a new regime of interest rates moving higher, and as such, we paired a lot of those positions. By no means are we underweight technology, but we had naturally gotten overweight technologies, I think everyone else had, just from the market appreciation. And so we just rebalanced in order to bring that back to a more market weight rather than necessarily a market overweight. And so obviously, given the way things have happened this year, that's turned out to be a good thing. But if we do head into recession, which we do think is likely in the next year or two, some of those technology names, like the ones that you're seeing selling out today, those really big cap tech, the ones that have great balance sheets, that have pricing power, that have a really great business model, they're the ones that are likely to probably do well through the next recession. So that's the conundrum I think people find themselves in.
All right, going to leave it there. Hey, Chris, thank you so much. Chris Zaccarelli, Chief Investment Officer at Independent Advisor Alliance. They are a registered investment advisor, and he joined us on the phone from Charlotte, North Carolina. We've got just about 3.5 minutes left in today's trading session. We, folks, have bounced off our lows of the day. S&P now down just about 14 points, so just a little bit lower there. Dow Jones Industrial Average, a decline of 181. That's about a 0.6% decline. And the NASDAQ, which has really continued to beat down, already we've seen the NASDAQ, certainly the NASDAQ 100 hit a bear market. It is down just now about 12 points, or down 0.1%. So definitely off its lows of this session. Coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We are counting you down to the close on this Thursday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick, Caroline High, Taylor Riggs counting you down to the closing bell. Here to help take us beyond the bell. It's our global simulcast with Carol Masser and Tim Stenovic. We welcome our audiences across Bloomberg Television, Radio, and YouTube on another wild day. Wild swings again. We moved lower pretty early in the session. We moved higher not too far into that session. Then we moved lower, and now we're basically kind of flattish on the day.
It's roller coaster.
Call
It's
it
seesaw,
even.
right?
Even
it's
Steven.
like, what?
Even Steven.
Even Steven. Yeah, it's kind of interesting, right?
Can you hear in that ear, or should I speak into the other one?
Are you saying something? No. The NASDAQ 100 alone, we're talking about a 3.7% swing. So it is pretty remarkable. NASDAQ right now, just by a hair, up 2 points, so going into positive territory again.
We just had a really interesting conversation with Chris Zaccarelli, the Chief Investment Officer at Independent Advisor Alliance, and he said days like today, hey, in the last 5 weeks, get used to it, because he thinks that's what the remainder of the year is going to look like.
We've heard a lot about that, sort of getting through October, actually, which could be a volatile session until then. I think we think about the path forward for the markets. And Caroline, we've also been having some good conversations about the path forward for economics, hearing further here from Fed officials that the economy can support some of these 50 basis point rate hikes that are on the horizon.
And 50 basis points coming from Mary Daly, still 75 basis points being discussed by some when you see the PPI number rush in as it was. But overall, this is, when you see these sorts of correlations, we've got to think that generally speaking, this is the Fed having its factor in the markets at large. And is this kind of actually what the Federal Reserve wanted to see, the financial conditions starting to push lower?
I mean, yeah, they said that's exactly when they see we've got that. I guess the question is that enough for them? Do they stay the course at 50? Do they maybe pause? Or do they act a little bit more aggressively and go towards 75? That's the question that has to be answered. And unfortunately, we got to wait 2 more weeks before we get a definitive answer to that. Meanwhile, here on this day, again, we're basically flat across the board here. And if you just woke up right now and look at the closing numbers here, you would think that nothing happened. The Dow Jones Industrial Average down about 0.3%. The NASDAQ Composite actually finishing in the green. And we should point out, the NASDAQ was down as much as 2%. Then it was higher by about 1.6% at one point on the day. Basically flat, unchanged on the day. It's up by basically 7 points on the day. And as for the S&P 500, I do want to point out, too, it's going to close down, but only by about 0.1%. And once again, about a 2% oscillation to the downside, almost 2% to the upside. But we've had all week long now 4 straight days where we've had a 100-point swing from peak to trough on the S&P 500. So that gives you some idea of the volatility here. And how about this turnaround here? The Russell 2000 right now going to finish the day strong. I mean, you blink and you miss it, because this was sort of the outperformer all day long, but it was still down about 1%. It's going to finish the day higher by about 1.2%, Carol.
Oscillation, I like that. Well, despite that oscillation, if you take a look at the S&P 500, we had almost an even split. 295 names actually gaining today and 209 lower. Who would have thunk, Taylor, with what it seems so extreme to the downside at one point?
Yeah, really interesting. And Carol, you're right that sort of 2 sectors below the S&P 500. The story looks pretty similar, certainly a lot better than it did maybe an hour or 2 ago. A little bit more green than there was, but it still feels a little bit defensive. If it's the durables and it's telecoms and it's real estate, those are the sectors that are up 0.6% to almost 2% or so. There was a little bit of red and there was some decent selling pressure here, Carol, still at the bottom, but it is everything that you would think it would be, with the financial, software and services, auto components, and of course, tech, hardware and equipment. The worst performer on the day, off about 2.3%.
All right, so let's get to some of the specific gainers. Tapestry among them, up 15.6% here at the close. Number 1 in the S&P 500 among the gainers. We talked to the CEO. They're optimistic. She is optimistic about the company, confident. They're investing in technology. Says the consumer is quite resilient. So interesting to see that the company did cut its earnings and revenue outlook for the year. But I think, Romaine, you talked about this, that North North American demand really helping that third quarter sales number.
Yeah.
Sonos, also an outperformer, and that's thanks to Sonos. Do you know?
That's the speakers.
Yeah.
Oh. Okay. Go proceed.
Okay, thank you.
Yeah.
We're talking to the CEO in a few minutes.
Oh, okay.
We'll say it.
You can send him over here to TV when you're done.
He's a good interview.
He's a great interview. He's up 14%. No, he's not up 14%. The shares are up 14%. Maybe he's up 14%. They maintain their fiscal year 2022 revenue guidance. Analysts pretty impressed, and they're launching some new devices. So we're going to get into that. So they are certainly making investments and coming out with new products. Dish up about 15%, sold off 20% yesterday on some investment disappointment over the company's 5G network outlook. It's top in the S&P 500. And Hollywood Reporter outlet yesterday on analyst speculation that the slide yesterday might hasten a DirecTV merger, which is something Dish's chairman sometimes floats.
A DirecTV merger? How long has that been floated now?
Well, exactly. I know, right? You can kind of throw that out.
I know.
Anyway, all I'm just going to say is it's higher today.
All right.
Yeah, what's old is new again. Well, speaking of selling off, you had the gainers, I had the decliners, Carol. Let's start with Apple, closing down 2.7% to its lowest level since October 13th. Is now down 21.5%
Explain this to me, Tim.
from those January highs.
Explain it to me like I'm 5.
I mean, everything is getting hit, but it's not down like Netflix. But like you said earlier, Romaine, I think there is concern that when a company with earnings like Apple's and with a cash position like Apple's, when it's seeing sell-offs of close to 5% in a session, then people are taking risk off the table.
Did you say like your 5?
Yeah. Well, I mean, Carvana finished the day higher by 25%.
I can't explain that.
But that's been so underpriced.
I mean, you know what I noticed when Carol had her gainers board up? All of those were double digits.
Yeah. I mean, there were a lot of double-digit gainers.
Yeah, so it's just a lot of volatility.
But not Apple.
Yeah.
Or Microsoft.
No, exactly. Not the,
or Google.
The sort of bellwethers of the S&P 500. Let's talk about AmerisourceBergen. It was among the worst performers on a percentage basis today, finishing the down by 6%. It's the pharmaceutical services and healthcare products company. It did fall after Walgreens Boots Alliance said late yesterday that it sold 6 million shares, so reducing its stake in the company from just over 28% to just about 25%. And speaking of double digits, Dutch Brothers, the drive-through coffee chain, hitting an all-time low today, cutting its forecast for adjusted EBITDA for the year, also lowering its full-year guidance for same-store sales growth below analyst estimates. It was down as much as 41% today.
Yeah.
Wow. Commodity-related company there, and also one that recently went public. Let's go across the commodities. Let's go across asset for our audience. I'm looking at a radio move that is, once again, oil pushing that little bit higher. We're seeing up almost a percentage point, $106 where we trade on WTI crude. Now, once again, this is about worry about IEA, for example, this time. International Energy Agency is saying, look, stockpiles are super thin right now, so therefore we're worried about the supply-demand imbalance. And for once, we actually pull back in terms of natural gas here in the US, but not the same over in Europe, spiraling gas prices. We once again concerned about that war, Russia, Ukraine, what that means for overall sanctions, what that means for overall gas prices. I'm looking at metals coming off the boil a little bit as we worry more about global growth. China in particular, the worries about further shutdowns due to their COVID-0 policy. What does that mean for copper, for example, coming down? I'm looking at a story of red across the board when you look at foreign exchange. We are talking potential parity. Well, we already got it with the Swiss franc today. We're looking at the euro 1.3% on the down. We're seeing it weakening against the US dollar, 1.03. Could we get to euro parity? Could we get to pound parity? That's something that John Authers is writing about at the moment. Great British pound also weaker. We see the Japanese yen, the one area of strength. After 2 months of being under such pressure, as we worried about what generally the Bank of Japan will do so much later than any other central bank, once again, the old school havens come back into vogue. And I go to the havens in Europe that was also the bond market, Taylor.
Indeed, and you certainly saw that today. Sort of a second day where some of the correlations came back into focus with bonds providing that classic safe haven of which they historically have. Really interesting moves here, down 7 basis points on the 2-year yield. So you're all the way back down to a 256. We've talked a lot about the 3s and the 10-year sort of weaker auctions, a 10-year yield that falls 5 basis points on the day, and a 30-year auction that was okay. And so that is unched, but you're coming back down to that key 3% level here as you get a little bit of an unwind. Carol, of sort of all of this push forward here in yields, Romaine.
Yeah, I mean, believe it or not, we're still getting earnings crossing here, despite the fact that we're almost towards the end of the earnings season. This is a firm, those shares actually higher by about 20% here in after-hours trading. Their fiscal 3Q revenue coming in at $354 million. That's a slight beat over the $344 on average that the street was looking for. They did post a loss for that quarter of 19 cents a share, but that loss smaller than what the street expected. They were looking for a loss of $1.06. Now, a couple of interesting other things here. They are saying that they're extending their multi-year 5-year exclusive partnership with Shopify here. So remember, this is a company that really does depend on those partnerships. There was a lot of concern, if you remember, guys, that this company was maybe a little bit too wedded to one of those partnerships, Peloton, but they've since tried to diversify away from that with deals with Amazon and Shopify. And I guess for right now, investors seem comfortable.
The stock, though, has been getting beat up. It hit a 52-week low today, down 82% so far this year. So.
Yeah, well, and I think it's interesting that that's the key sort of headline that we're getting, not a lot more about the quarterly results. And I think it was interesting. We were having conversations with Nadia Lovell earlier saying that pretty much on the whole, the forward guidance has actually been pretty good. Certainly seems a very different story with some of these tech companies here about forward guidance, if you will.
All right, so firm up about 29%. Poshmark crossing the Bloomberg terminal. That stock's up about 3% in the after hours. Second quarter, that's the outlook. EPS loss of 18 cents versus a loss of $1.18. That's a year-over-year comparison. That loss is smaller than what the street was expecting for this current quarter. So the outlook, the street was looking for about 24 cents. Second quarter revenue, again, playing to the outlook, 86 to 88 million. That, too, though, is a little bit light here.
And I want to go back to Taylor's point here about the beats. So not to throw cold water on it, but I was actually looking at these numbers a little bit earlier. And the number of companies that actually provided guidance, though, was a lot smaller than what it used to be. So, I mean, a lot of companies basically just decided we're not even going to put it out there. So yeah, the guidance overall is pretty good, but I think you only had something like 79 companies in the S&P 500 even providing EPS guidance, and there were even fewer companies in the S&P 500 that actually provided revenue
Another
guidance.
newbie, Figs, of course, which dresses every nurse that you ever see on Doctor, they're dropping because they cut their full-year revenue forecast. So one company that's giving some sort of transparency.
All right, and we did talk with Jess Minton, right, earlier, Tim, and talked about earnings revisions. They're starting to come down, so we're seeing that certainly when we do see some outlook from a company. All right, guys, that's going to do it. That's wrapping up our Thursday edition of Beyond the Bell, our cross-platform coverage, counting you down to the close on radio, TV, and YouTube. We will see you again, same time, same place, tomorrow. Bye.
This is Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Let's head now to our newsroom to get a check on the latest world and national news with Denise Pellegrini. Hey, Denise.
Hey there, Tim. Well, what we're tracking is that House committee investigating the January 6th assault on the U.S. Capitol, and it has, as we've been reporting, subpoenaed GOP House Leader Kevin McCarthy. And Bloomberg Government's Emily Wilkins caught up with McCarthy in the hallway just a little while ago. And here's what McCarthy's response to the whole thing was.
I have not seen the subpoena. I guess they sent it to you guys before they sent it to me. Look, my view on the committee has not changed. They're not conducting a legitimate investigation. It seems as though they just want to go after their political opponents.
All right, and that's McCarthy with us there. And Washington correspondent Joe Matthew, well, he points out there are others who are being subpoenaed as well.
Kevin McCarthy and 4 other Republican members who refused to testify when they were requested. Now they're going to be compelled by subpoena. It's McCarthy. It's also Jim Jordan of Ohio, Scott Perry of Pennsylvania, Mo Brooks of Alabama, and Andy Biggs of Arizona.
And Joe Matthew will have a lot more with us on that developing story coming out at 5 p.m. Wall Street time here on Bloomberg Radio. Also on Capitol Hill, as we've been reporting, Fed Chair Jerome Powell has won Senate confirmation to a second term. President Biden under fire for the FDA's delay in fixing the baby formula shortage. Biden today speaking with formula manufacturers, including Gerber Scientific, and announcing new actions to increase supply and also moving to fight price gouging. And Finland's leaders have come out in favor of applying to join NATO, and Sweden could do the same within days. That would be a historic realignment on the continent just a couple of months after Russia's invasion of Ukraine. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists.
All right, Denise, thank you so much. Denise Pellegrini with World and National News. So we want to get to a story that certainly popped up on our radar, and it has to do with what's going on with the Manhattan apartment rental market.
Talking to a friend last night, saw some friends last night who I hadn't seen in person in a couple of years. He told me they signed a 2-year lease on their Manhattan apartment. They moved during the pandemic. He said, I'm so grateful we signed a 2-year lease because the folks who are my neighbors just got their rent jacked up after 1 year by 30%.
Well, that's what's interesting, right? Remember during the pandemic, people were moving around and they were talking about all these great
January
deals.
of 2021 was like a great time to snag a deal.
But a lot of people were signing deals that were like 18 months.
Yeah.
Like they were very limited in scope.
Landlords were desperate.
they were desperate, but they were very careful not saying, okay, well, here's a long lease, right?
We do have friends who did a 5-year lease.
Do you
yes,
really?
Yes,
They must be
locked
like,
it in. They are sitting pretty right now.
All right, so Manhattan apartment rents soaring last month
This was
in
Brooklyn,
April.
though, Carol. That was Brooklyn. Okay.
Oh, yeah.
Sorry.
What happens in Brooklyn?
Yeah.
Manhattan apartment rents, this is what we're talking about, soaring in April to a record high for a third consecutive month, and signs point to even costlier rates on the horizon.
Tenants paid a median of $3,870 on new leases signed last month. That's according to a report Thursday by the appraiser Miller Samuel Inc., also the brokerage at Douglas Elliman Real Estate. That's up 6.2% from the previous record. That was set back in March, and that was 39% higher than April of 2021. That's interesting. So in raw numbers, the median rent jumping $226 from March to April, much bigger than the $14 increase from February to March. So 39%. So my friend's neighbor with a 30% lease
actually doing okay.
Doing okay.
Yeah, let's see how they feel about it if you tell them that. What's interesting is Jonathan Miller, president of Miller Samuel, saying there was some suggestions that pricing was starting to peak or get close to it, but now we have this massive surge in April and signs it will keep going up. He says there's still a tremendous potential for rental price records to be set and a continuation of extremely low vacancy. So much for people leaving Manhattan.
2 years ago, the conversation we were having, just,
everybody's leaving.
Does it ever recover?
And anybody who's a New Yorker was like, no, they're not. They'll come
Covered
back.
and then some, right?
Exactly. All right. This is Bloomberg Radio. We're talking to Sonos in just a moment.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. An up day for the NASDAQ Composite Index. S&P ended a little change, lower by 0.1%. At one point, the S&P was down 1.94%. The Dow today fell 103, down another 0.3%. Stocks almost wiped out losses into the close, but brutal volatility continues to grip American financial markets, roiled by the threat that restrictive policy by major central banks will throw the global economy into a recession. S&P almost erased its losses into the close after Federal Reserve Bank of San Francisco President Mary Daly told Bloomberg News that a 75 basis point increase in rates is, quote, not a primary consideration. 10-year yield 2.86%. Again, the S&P 500 index down 5, drop there of 0.1%. Spot gold down $29 the ounce to $18.23, a drop of 1.6%. And West Texas Intermediate crude gained 1%, 106.73 a barrel. Fashion retailer Poshmark reporting net revenue for the first quarter that did beat the average analyst estimate. Shares today did hit a 52-week low. Poshmark sees second quarter revenue in the range of 86 to 88 million. Estimates were for 89.9 million. Restaurant software company Toast reported first quarter revenue of 535 million. Estimates were for 491.9 million. Toast, after hours, up by 5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We told you we had a CEO extravaganza, so we're so delighted to get to another leader and talk to him about the environment. And specifically, we're talking about Sonos and Patrick Spence. Sonos shares, by the way, up 14%. This company really shares taking off today. This after the company maintained its fiscal year 2022 revenue guidance, trimmed the high end of its adjusted EBITDA forecast, but analysts weighing in saying the 2Q print was, quote, impressive, and talked about solid growth trends for the company.
Patrick Spence is the CEO of Sonos. We are joined by him once again. He's joining us from Santa Barbara, and if you're tuning in on YouTube, you see him via Zoom as well. Patrick, how are you?
I'm good, Tim. How are you doing?
I'm doing well. We're doing well. Talk to us a little bit about the quarter and what really worked for you guys, specifically supply chain challenges, because that's something you've been talking to us a lot about over the last year as we've been speaking with you pretty much quarterly. Give us an update there.
Yeah. So again, the team came through, delivering better than expected. Really, there's been a ton of demand from our customers, and that's continued. So we talked last quarter about the backlog. We've been working through that. We still have a backlog, so we still continue to see strong consumer demand. And I'm so thankful and proud of the way our team has continued to execute to actually be able to, go above and beyond and actually deliver in what is such a challenging industry-wide supply chain kind of environment.
Hey, Patrick, backlog, how much of it is just trying to keep up, or how much is it because the supply chain has created some of that backlog?
Oh, it's all to do with supply chain. I mean, we're seeing those challenges that everybody's seeing in Shanghai with the ports. We do some manufacturing in China. Thank goodness we diversified into Malaysia, and we're also diversifying into Vietnam. So we were able to deliver more than many companies. We've navigated the last 8 quarters better than most. Components remain a real challenge as well. So it's all supply chain at this point. Everybody's talking about consumer demand, but from everything we see at this point, consumer demand remains strong.
I love what you said about your supply chain, diversifying to Malaysia and elsewhere. Are you going to continue to do that? Like, how do you think about the supply chain post-pandemic?
Oh, yeah. I mean, post-pandemic, and then as well, I think geopolitically before that, right, we were thinking, okay, we need to be more diversified, make sure that it's more resilient in the face of some of these challenges that happen. And if anything, these zero COVID lockdowns in China have just really underscored that. So we'll continue to do that and try and build more resilience, more flexibility into the system as well.
Help characterize where you are with supply chain challenges. Are you in a better position than you were in last time we spoke back in February? Or are backlogs worse at this point because of COVID-0?
Yeah, well, you may recall that back then we thought that by the second half of 2022, things would get a little bit better. It does not look like that right now. So this quarter in particular is going to be challenging. And it looks like right through 2022, we'll see component challenges. Let's hope, COVID restrictions lift, right? And we end up in a better place in China. But components do not look to be getting that much better. So that's why, we had to kind of factor that into our forward guidance for sure. We're still confident we can, navigate these choppy waters customers to deliver the kind of revenue that we'd set out to, but it's going to cost us a little bit more.
How much more is it going to cost? Because we're seeing inflationary pressures throughout the supply chain right now. And look what consumers are experiencing as well. They're seeing those inflationary pressures even beyond just energy and food. What specifically is costing more? How much more is it costing? And how much are you absorbing that versus raising prices?
So we're absorbing all of it right now. We raised prices last September. So it was about an average of 10% across the board. We saw continued strong demand, so we didn't lose any momentum off the back of that. So I think it shows kind of for our customer, at least, some degree of price inelasticity, if you will. But you always want to make sure that you're optimizing for the value you're delivering for those customers. But Tim, it's really two things. One is the component costs. So we're seeing, just astronomical component costs out there today. So we've factored that in. And then the other thing is these logistics, the shipping, the management, all of that we expect to stay elevated for a period of time. And so it's really translated into about a half a point on our gross margin. The nice thing is we've done a lot of work in that area over the last 5 years. So we'll still be within our long-term guidance range of 45 to 47% gross margin, which is pretty incredible in this day and age. But, there's been a cost in terms of doing that. But we're managing that and making sure we deliver for customers.
Managing it and also developing and introducing new products. Tell us about Sonos voice control.
Yeah, so something that really builds on an acquisition we made a couple of years ago. We've created a voice assistant, which is very focused on the Sonos experience itself. So being able to control Sonos speakers, really go deep with music services as well. And one of the most important things is that it really respects your privacy. So all of the processing is done on the Sonos speaker, as opposed to going to the cloud, which is done with Google and Amazon and some of the others. We do not collect your data. We don't want to advertise to you, all of those things that I know so many people have been concerned about. And so we think it's going to be a real hit with our customers. And it's not exclusionary to Amazon or Google. You can run those assistants as well on a Sonos speaker. This goes in addition to it. So we're super excited for people to try that out.
So Patrick, full disclosure, we always do this to our audience. Both Tim and I are customers of Sonos, know the brand well. So can this new voice control, can we tack it on old systems?
Yes, you can. As long as you have a voice-enabled speaker, it'll be available in the United States June 1st for anybody that has a Sonos voice-enabled speaker.
So we just download the new firmware?
You got it.
We want the advice.
And you're ready to roll.
All right, there you have it. I'm talking to my
Sonos gets better over time. That's the promise.
All right. Listen, great to check in with you once again. Patrick Spence, he's president and CEO at Sonos, joining us via Zoom from Santa Barbara. As we mentioned, the stock, investors definitely moving it in what was a very, very volatile day. We ended up kind of little changed over all those major market averages, but shares of Sonos up 14%, 21.72, the last print at the close. You're listening to Bloomberg Business Week. Carol Masser, Tim Stenevec. This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right. So I've been thinking a lot about what do you ask somebody who is credited with creating the iPod, building the iPhone, founding the smart home company Nest. I mean,
I know what you ask him.
What do you ask him?
What's it like to fail? Because at the beginning of his career, there were a lot of failures.
All right, so we're going to put that question to Tony Fadell. He's got a new book out. It is called Build, an Unorthodox Guide to Making Things Worth Making. So we're going to get to him in just a moment.
First, though, let's get a check of what's going on when it comes to after hours. Here's Charlie Teller.
All right, indeed, lots of news. We're talking about presumably the end of the iPod. Apple shares today down by 2.7%. What a day on Wall Street. We didn't see a reversal for the S&P, but certainly narrowed those losses, ending the day down just 5 points. At one point, the S&P had been down 1.9%, ended with a loss of 0.1%. NASDAQ had an up day, picking up 6 points, up by 0.1%. The Dow ended the session lower by 103 points, down 0.3%. We are keeping an eye on Robinhood Markets. After hours, that stock now rallying 23% after Emergent Fidelity Technologies reported a 7.6% holding. According to a new 13D filing with the SEC, the stake is equivalent to about $567 million. So again, look at Robinhood. It is rallying after hours, up now by about 23%. Federal Reserve Bank of San Francisco President Mary Daly is backing raising rates by a 0.5 percentage point at each of the central bank's next two meetings, adding she would like to see financial conditions tighten further. But those remarks helped ease losses as brutal volatility continued to grip financial markets, roiled by the threat that restrictive policy by major central banks will throw the global economy into a recession. As for the market backdrop, Chris Zaccarelli is Chief Investment Officer for Independent Advisor Alliance. He was our guest right here on Bloomberg Business Week.
I mean, I think the market has been a challenge, absolutely, and clearly we've had a lot of volatility, but I think it's not completely unexpected, given what the Federal Reserve needs to do to get inflation under control. We can't say we're surprised, but obviously we'd love to get through this period of market turbulence as quickly as we can. Unfortunately, there's nothing we can do to control it, so we just have to ride through the volatility.
And again, we do have the 10-year at 2.85%, 10-year up 15.30 seconds. Gold today down $29 the ounce, tumbling 1.6% to $18.23. West Texas Intermediate crude up 1%, $106.74 a barrel. Again, recapping, equities finished mixed today with the S&P down 5. Volatile session down by 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As we mentioned, our next guest credited with created the iPod, building the iPhone. He founded the smart home company Nest. He spent more than 9 years at Apple, including being advisor to Steve Jobs, who was then CEO and, of course, co-founder of Apple. In the past, our next guest has talked and tweeted about device addiction and Silicon Valley's responsibility to fix it.
We're talking about Tony Fadell, the principal at Future Shape. He's the founder and former CEO of Nest Labs, as Carol mentioned. He's got more than 300 patents to his name. He's also the author of a new book. It's called Build, an Unorthodox Guide to Making Things Worth Making. Tony joins us from Palo Alto. Tony, good to talk to you again. How are you?
Great. Thanks, Carol. Thanks, Tim, for having me on. It's great to be here.
It's good to have you with us. Hey, we got to start with the iPod because the end of an era this week, Tony. I know you know, but Apple, after 20 years, finally discontinuing the iPod. This is a product that you are credited with helping invent. Talk to us about what it means for Apple to discontinue it and the impact that the iPod has had, not just on Apple, but on consumer technology.
Well, the iPod, it's bittersweet, obviously. You see your baby go. But, at the end of the day, the march of technology, the drumbeat of technology never stops, right? And I've been in this business long enough to know that you can't get too wedded to any one thing because, you might have to eat your own. And that's exactly what the iPhone did. The iPod created the conditions at Apple to be able to make the iPhone. So without the iPod, there would have been no iPhone. So it feels really good to know that what we did in the iPod and brought Apple into where it is today. You know, it was last week, I guess, the most valuable company on the planet, and that was because of the iPod.
Well,
that's really, really wonderful to know.
Well, and Tony, talk to us about your journey, because that's so much a part of this book, Build, and who you wanted to read this book, and what lessons you hope, or what you hope people would take away from reading it.
Well, I think, you know, I stepped back and I thought about the mentors that I've had over the years, and that's the reason why I'm able to talk to you today, is those people helped me. And if I didn't get that help back in the day, maybe I would not be here. And so when I thought about those mentors, most of them had died. And I thought, oh, it's now my turn to be mentor. And so how can I do that at scale and take the journeys through companies like General Magic and Philips and Apple and Nest, and all the lessons learned on building transformative technology, and really the books about human nature. So I'm trying to really go for, you know, what were you, if you were in high school or if you were in college or a new grad, what do you need to know? Look behind the scenes of the products that you probably grew up with, and how those were developed, but not just like from a technical point of view, but from a human nature point of view, building your career, building products, building teams, companies, businesses. So it's all about trying to give back to help those people with their careers. And hopefully one day they'll change the world as well.
Well, so how did Steve Jobs help you?
Well, you know, I think for me, you know, he's helped, one, by giving us an environment to actually thrive, to be able to create the iPod. That was the first thing. But the other one is really to learn about storytelling in detail. And what happens is you really need to not just create technology for technology's sake. That's what happened at General Magic, and that's what I learned so painfully about the disaster that was that company. And so watching him masterfully tell a story, a non-fictional story, through marketing and through the products that we created and all the customer touch points, you know, you get to see a master at work. And then we were able to then take those lessons and create a company like Nest and change the world there with a small, tiny team, because we learned how to do it right. And Steve really was a master storyteller with using technology.
Well, we're going to continue the conversation. We've got to do a little bit of news, Tony, but we will come right back to you. Tony Fadell, he's principal at Future Shape. They fund early stage companies. They invest in what they say is deep technology. They don't call themselves a VC firm. So we'll maybe get a little bit into his philosophy there. He's got a new book out. It's called Build, an Unorthodox Guide to Making Things Worth Making.
Yeah, you also know him as the founder and CEO, former CEO of Nest Labs, and he had a long career even before creating the iPod and helping create the iPhone. We're going to have much more with him in just a few minutes. In the meantime, though, let's get over to the newsroom here in New York City for a check of the latest world and national news with Denise Pellegrini. Hey, Denise.
Hey there. Well, House GOP leader Kevin McCarthy being chased by reporters in the hallway today. They're all asking what his response will be to being subpoenaed.
What does this mean for the future? Are you going to comply? Are you going to comply?
And McCarthy telling us he is really skeptical of this whole process of being subpoenaed after being subpoenaed by the House panel investigating the January 6th riot.
Look, my view on the committee has not changed. They're not conducting a legitimate investigation. It seems as though they just want to go after their political opponents.
And McCarthy and the four others subpoenaed Representative Jim Jordan of Ohio, Scott Perry of Pennsylvania, Mo Brooks of Alabama, and Andy Biggs of Arizona have all already rejected requests to testify voluntarily. The Biden administration announcing it's taking active steps to alleviate the baby formula shortage, according to White House Press Secretary Jen Psaki.
Today, President Biden spoke with retailers and manufacturers, including the CEOs of Walmart, Target, Reckitt, and Gerber, to call on them to do more to help families purchase infant formula.
And Psaki also saying the White House is concerned about price gouging. Calling a male colleague bald is apparently sexual harassment. That's the ruling today from a UK court. The Employment Tribunal ruled that using the word could be inherently related to sex and amount to a form of discrimination. And as we've been reporting, it's looking like it'll be a long, hot summer in the Manhattan real estate market. Rents hitting a record high in April. The median up more than 6% from March levels. And that is a sign that rents are going up even more from here. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Denise Pellegrini, and this is Bloomberg.
All right, Denise, thank you so much. Some headlines crossing the Bloomberg terminal. Fed Chief Jay Powell repeating 50 basis points hikes at next two meetings are appropriate, but also saying that he is prepared to do more, and also saying a soft landing may depend on factors we do not control. And we've often talked about the Fed can't really control inflation per se. All they can do is maybe impact some of the demand side of the equation.
Yeah, when the Fed chair speaks, the market listens. Hey, let's get back to Tony Fadell. Tony, we have a couple minutes with you right now, and then we're going to come back, do some more news, and then we'll come back. Tony Fadell is principal at Future Shape, also the founder and former CEO of Nest Labs. He led the teams that helped create the iPod, iPhone, and the Nest Learning thermostat. Tony, when people hear an intro like that, they think of all the successes that you've had in your 30-plus career in hardware, but your book also goes into failure. Specifically the first 10 years of your career before you were on the team at Apple that helped create the iPod. Tell us a little bit about that and the lessons that you learned in failing before succeeding.
Well, through failure, that's really the only way you learn. You know, in school, you're taught that failure is failure, and you need to learn and get an A, right? In life, it's exactly the opposite. When you fail and you keep pushing forward, you actually learn. And so the failure that was General Magic, which was creating the iPhone just 15 years too soon, right? There's a whole movie about it. What I learned there was that we were making a product for other geeks. We were trying to impress each other. We weren't trying to solve pain for customers that were in the world at that time, right? We didn't even know that there was such things as email and downloadable games and all that stuff till 15 years later. So that was one big thing. At Philips, where we created the Philips Velo and Nino, these were handheld products, I also learned about sales and marketing and how critical it was to, if you had a great story, to tell it properly.
Hey, Tony, hang on a second. We're going to continue, do a little bit more news, and then we'll continue with you. Tony Fadell over at Future Shape. His new book is called Build. We're going to continue that conversation. You are listening and watching on YouTube, Bloomberg Business Week. Carol Master, Tim Stanovic. This is Bloomberg Radio.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Fed Chair Jay Powell is reiterating that raising rates by half percentage point increments at the next two meetings is likely to be appropriate, though the central bank is prepared to change course depending on incoming data. We continue to monitor Robinhood market shares after hours. They are now up by 33% after Emergent Fidelity Technologies reported a 7.6% holding. This according to a new 13D filing with the SEC. That stake is equivalent to about $567 million. Again, Robinhood after hours up now by just about 33%. Turned out to be an update for NASDAQ. The S&P 500 index finished well off session lows. At one point, the S&P was down 1.9%. It ended the day with a loss of 0.1%, down again by 5 points. The Dow lower by 103, down by 0.3%. NASDAQ higher by 6, up by 0.1%. 10-year yield at 2.85%. Spot gold down $29 the ounce, down 1.6%. 18.23 the ounce. West Texas Intermediate crude up 1%, 106.73 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I want to get right back to Tony Fadell, principal at Future Shape. As we talked about, spent 9 years at Apple, credited with creating the iPod, building out the iPhone. He also founded the smart home company Nest. He's got a new book out. It's called Build an Unorthodox Guide to Making Things Worth Making. And Tony, what I wanted to ask you is, what's worth making in today's environment?
What in terms of the environment?
Just in general, like
so
where do
many,
yeah. Oh, go ahead. I'm sorry.
Yeah. How do you make things worth making? So I always start with the pain. I'd much rather go where customers have pain. I don't want to give them vitamins. Some people like vitamins. Not everyone needs them. When you have pain, you need to squash that pain down. And it's even better if you give them a painkiller and a superpower at the same time, so they can do things with the product or service that they never thought possible before, and they feel like they have new superpowers. And so you really have to focus on the pain and do it in a way that people feel really amazing about it.
Okay, so it's clear how you did that at Nest with the Nest Learning Thermostat, a product that continues, I think, to solve a pain point in many consumers' lives.
We both have them.
Yeah, we both have them.
Full disclosure.
Tony, but where's the pain? Where's the pain today? Because I look around and I see the innovation at a company like Meta Platforms, for example, and that's the metaverse. So do we feel pain in the real world and need to be in the metaverse?
I feel real pain from the climate crisis we have, and the health crises we have, and our social crises we have that were generated out of disintermediation between humans. It first started with text and video and photos, and now we're going to say we're going to go in the metaverse and we're going to get connected and dance and have meetings. To me, that's toxic. We've seen what it's done in the past. You're not going to get into the metaverse. People are not going to want to go and live in there and dance in there and connect. We need to have controls on that stuff before we ever, we've been talking about controls on text and Twitter, all these other things, these social platforms. Why do we want a new environment where it disconnects us even more and allows more toxicity to grow? Let's fix the social problems we have with the technology we have. Let's not create even more of them. So let's go, and also let's fix the problems in the real world, the climate crisis that we have. There are so many things that we need to address right now, and these goals that we have are coming so quickly. If not, we could lose it all. It's absolutely astonishing to me that we are diverting incredible, smart, brilliant brains and resources to things that are not solving the real problems that we have today.
So, you talk about social and the social universe. Do you think Elon Musk is someone who can fix Twitter to some extent and some of the downside of that social media platform? And I don't think I'm saying anything subjective. I think many would argue that it can do a lot of good, but it can also do a lot of harm, like other social media.
Absolutely. It's not just Twitter. There's so many things. But could he fix it? He could fix it if he wants to fix it in the right way. I think what we have to understand here is we can't just go putting people back onto the Twitter platform if we don't change the environment at which they come back onto it with. If we continue to drive, revenue based on amplifying misinformation and these kinds of things, then we have not done anything to fix Twitter or fix these social networks. We have to divorce the amplification mechanism from the revenue mechanism. If we don't do that, the toxicity will only grow, and we can't just let anyone on to say free speech. Free speech in the town square was never amplified. We should not amplify that for revenue purposes.
Do you think, Tony, some of these big tech companies have just become too big and kind of too controlling in terms of the narrative and the trend of where technology is going?
I think with great power comes great responsibility. And if they can't rein themselves in, then they're going to need to be reined in by the government or what have you. The inequity is growing so dramatically, and the concentration of power is growing so dramatically, not just in the people who use the products or are used by the products, but also the ecosystems they create. And they continue to extract so much revenue from apps or what have you. It needs to be rebalanced. If not, we saw this in government. When there's inequity, there's revolution. They're going to have a revolution against them if they do not rein themselves in. So I do see the power growing too strong, and they're going to have to modulate down. Otherwise, they will be forced to do so.
Tony, last time you and I spoke was, I believe, back in 2018, and you were at that time pushing for controls on Apple products specifically, monitoring how much we were using those products to give Apple customers an idea of just how much time they were spending on their phones. Apple has since done that, and each week I get a really depressing report that shows how much time I'm spending on Apple devices. Are you satisfied with that type of disclosure that you're seeing from Apple right now, and what have you learned after taking on that project?
Well, that was something that they implemented based on public, reaction to, this social or this screen time addiction. I think we're only 50% of the way there. It was a good start, but there has been really no innovation and continuing to take it to the next steps. So I think we still need, not just Apple, but Google, all the different platforms, PlayStation even. They need to go after and start looking at this, what they can do for the screen time limitations and the information. So not just the tools and the control tools, but also the information by which we disclose what these apps can do, not just to kids, but also to adults. And if you look at it, they now added since that 2018, they added privacy labels to tell you what are the privacy things that these apps do and don't do. Why don't we have digital nutritional information about what these apps can do to kids or what have you when you do consume them? Do they have toxic ads inside these free-to-play games? Sure, they might be games that kids can play, but the ads that pop up, I've seen it with my daughter, they can be very toxic. And my daughter comes to me, screaming, going, "What is this, Daddy?" So I think we need to be much more on what's going on and what we're consuming, just like nutrition labels on the side of a food product. We need to have that for our apps for this kind of addictive qualities of certain apps.
We've run out of time. I wish we had more. Please come back, because we'd love to continue this and really pick your brain, too, about thoughts when it comes to health and climate and things that we could definitely do in a better way and really address some of those areas where there is pain in our society. Tony, thank you so much. Tony Fadell, principal at Future Shape. His new book, check it out, Build an Unorthodox Guide to Making Things Worth Making.
Thank you.
Good stuff.
Yeah, very thoughtful. And considering all that's going on in our world. All right, folks, Friday's Eve, just around the corner.
Friday the 13th, Carol.
Dun, dun, dun. Have a good and safe evening from the whole Bloomberg Business Week team.